Our selection is intentional, never incidental. We cross borders to find the right people to manage your money. We believe exceptional portfolios are constructed at the intersection of art and science. Data and structure matter, but so do experience, judgment, and conviction. That's why we are borderless, seeking out those with a clear philosophy, a disciplined process, and the character to navigate uncertainty wherever they may be in the world. In a world that can feel overwhelming, we don't add to the noise. We offer clarity. Bringing global talent that might once have felt out of reach closer to home. This is Curate, the art of investing.
When I was thinking about this conference and we were putting it together, I actually realized that it was 3 years ago, in Feb 2023, that we decided to take the concept of Curate investments and turn it into a reality. And obviously that takes time, and we needed to get investments. 18 months later, we actually launched the business on the 1st of August, 2024. And some of you were here at the same event for the actual launch. And then 18 months later, we're here today for the Curate Global Investors Day. So thank you for being here, and thank you for being part of our journey. Whilst we may be relatively new as an investment manager here in South Africa, I can assure you that the partners that we've selected and handpicked to manage our clients' money and your clients' money aren't new. In fact, one of them that you'll hear from today is almost 100 years old. When we thought about Curate and the name Curate and what it meant and how we wanted to show up in the market, we thought we had to think about what the name meant. And for us, the name meant two things. One, to take care of something special. And two, like an art curator, to select only the best and put it on display. And if you think about our business model and the way we operate and the way we take ourselves to market, we believe that we do exactly that. We do not underestimate or take lightly the fact that you have entrusted us with your clients' hard-earned money. Our commitment to you is that we will manage it with the respect that it deserves. We also believe at Curate that we've selected some of the best global investment managers who are going to help us take care of your clients' money. And today you're going to hear from many of them, and like a good art curator, we're going to put them up on display for you to select and choose. At Curate, we believe that investing is both an art and a science. The science is critical, and you'll hear Jan touch on that. Why? Because that's the data, the process, the risk management, the repeatability of that process. But for us, the art is also critical. That's where the humanity in investments comes in. That's the judgment, the perspective, the experience, and the context in which we live and in which our clients live, which is also where you come in. At Curate, we believe that we lie at the intersection of both of those. That's art and science. Now, why the Global Investor Day? We know that you're very busy. Especially this time of the year, you get invited to many of these kinds of events. And at times, to see global managers, you have to go to the US, the UK, and sometimes even China. At Curate, we decided to do something different. We decided to bring the managers here to South Africa so that you can see 5 of some of the best global managers all on your doorsteps, and you can hear from them directly in one sitting. What are those managers going to tell you about today? Well, they're going to talk about who they are, what they stand for, how they're navigating the current economic conditions, where are the risks, where are the opportunities. Something else that we've been deliberate and different about is we've selected different managers to manage our clients' portfolios. Why is that? Because we don't believe that you can be the best at quants fundamentals as one manager. We don't believe you can be the best equity, fixed income, and property manager. Our job is to go and select the best at each of those and then put them on display today. Naturally, what that means is you're going to hear some varying views today, which I love, And in fact, there's going to be some opposing views, which you may even hear on some of the panel discussions. But that is deliberate. The idea is for you to walk out of here so well-informed that you can go off and make well-informed decisions for your clients. Now, with no further ado, I am going to introduce our first speaker, and that is Sanisha Pakrisamy. Not foreign to many of you, I'm sure you've seen her before. She is the chief economist for the Momentum Group, and she's going to touch on America's shifting role in the current global economy. Thank you, Sanisha.
Good afternoon, everyone, and thank you so much for having me here today to go through some of our key macroeconomic views and just to take a peek into how we view the world. A couple of years ago, I would say that it was quite easy to neatly box economics and neatly box geopolitical outcomes separately. So it was quite commonplace for financial markets to react to things like a job sprint from the United States, CPI data with regards to price pressure, or even something like GDP, which we know is lagged. But today we're starting to see that markets are also starting to respond to geopolitical risks. So when we have an announcement by the US administration that they want to annex Greenland, or they want to make Canada the 51st state of America, we're starting to see that financial markets are also responding to some of these geopolitical tools that are coming out of the global economy. And so it's been against that backdrop where economics is now operating in an age of political noise, and it's become very difficult to tease apart the two. We've also ushered in a new world order in which the global operating system that underlies the underpinnings of the global economy are now starting to reset in quite a dramatic way. And it's in this kind of environment that we are starting to see that America is also sitting up and re-looking at their strategy and positioning in this world economy. So today on the agenda, we first of all going to look at why America needed to reset their economic and foreign policy agenda in this new world order and how it influences the rest of the global economy. Secondly, we're going to talk about what I call the rise of the rest. So quite often people think about the US policies, especially when we only looked at protectionist policies, as being a bit of a zero-sum game. But we heard very clearly out of the World Economic Forum in a key address by Mark Carney, who's the Prime Minister of Canada and a former BOE head, basically told us that as a middle power, you can actually emerge advantageously in this environment that is now shifting to a new world order. The third topic speaks about American exceptionalism. And we've often heard from investors, America, are they still exceptional in a number of facets? We think that this is still the case, but it is evolving. We'll also chat a little bit about democracy being in retreat. So a couple of years ago, you would have heard economists saying that one of the key risks to the economic and political outcomes globally are that we start to get more strongman leaders that are at the helm of politics. But that's no longer a fringe risk. We now have populist leaders that are firmly sitting in the driving seat. And then as number 5, we'll take a peek into the crystal ball, looking at some of the key macroeconomic scenarios we think can play out in the world economy with their respective geopolitical backing, and have a look at which scenario we think is more likely and how to basically invest in that kind of world. So on the US's strategic repositioning, we've seen that the economic outcomes and foreign policy outcomes are starting to be repositioned by America. They've realized that if they don't do that, they are going to see further losses being entrenched in their citizenry. And one of the reasons that they woke up to this reality is that they found that the Western model largely failed citizens. Democracy promised to take citizens along with it and increase the living conditions for many around the world. But in fact, democracy has failed many citizens. Now, why has the Western model failed? I think in large part because it did not produce enough middle-income jobs. And so we started to see inequality picking up in many nations. We also saw that governments, by and large, ignored large demographic trends to the extent that we're sitting with Europe that has a very underfunded pension system for a very large cohort of the population. And lastly, because of that inequality, we also saw a world in which we have the political elite and the rest, those that have been left behind. And this is essentially why people were so angry in 2024 when they voted at the polls. It was one of the biggest election years we've had in history, because citizens were looking for a political alternative to center-left and center-right politics to solve for things like the cost of living crisis and to deal with immigration in a manner that was much better than the current incumbent governments in these Western democracies. The result of that is that many of those incumbent democratic leaders were voted out and replaced by more populist leaders. They are now taking the baton over. They've inherited the problems of the cost of living crisis, of the immigration issue, of high debt levels, and of geopolitical risk. And the jury is still out as to whether they will be able to address these issues within their time frame that they are at the helm of the political scenario. We also see that the post-war liberal order is starting to unravel. We were very used to a world post-World War II where governments started to cooperate quite a lot with one another on issues that affected the world economy. So think about climate change, fiscal and debt dynamics, even something like health outcomes following the COVID-19 pandemic. But I think that most of these issues are now largely behind us, being dealt with in a multilateral setting. We now have huge political polarization that exists in economies like America. And that makes it very difficult for politicians to address things at a global scale when citizens want them to focus on domestic-led priorities. Now, this chart looks at government stability and how it shifted since the end of 2020. And what's quite interesting is that if you have a populist leader in place, it doesn't necessarily mean that you get penalized on this measure. You get penalized when there is no definitive outcome on the political situation for the next couple of years. And so if we look at America as an example, there's a bit of blue there saying that there's actually less instability in the American economy than what there was at the back end of 2020. So love him or hate him, Trump has actually delivered on his electoral mandate, and he has actually ushered in a period of political stability for the next couple of years. Where are we seeing the opposite? So we're seeing the opposite in Latin America, where there's a fair amount of pink and orange on the chart, suggesting that there's more government instability than before. Now, in Latin America, they put their trust into left-wing governments who failed to deliver on these socioeconomic outcomes, and now citizens are turning firmly to the right. If we look at Europe, also quite a lot of pink and orange on that chart. So we have the issue in France, where Macron is now the least popular president in 50 years. We have the UK with Keir Starmer with a popularity rating of only 18%. We have the case in Germany where there's far more support for the Alternative for Germany party, a far right-wing party. In addition to that, or maybe because of that, we've had very weak growth outcomes. So in the last 64 quarters, we've seen that Europe has struggled to grow above 1.5%, 2%. This is in stark contrast to the American economy, which continues to surprise on the upside when it comes to the growth figures, even for the fourth quarter of last year, where there was the longest shutdown in history. During Trump 1.0, Trump's main gripe with the Chinese economy was the extent of the trade deficit imbalance that existed between America and China. In Trump 2.0, this has now morphed into more of a trade tech war with China, on the basis that there is a huge global race to be dominant in this space. And what is important for this AI boom? Resources. So when I say that the global operating system has been rebooted, it's almost like we're loading up the 1.0 version of it, because we're going back in time to the pre-war era where resource imperialism was important. So we are again in that age where if you have things like oil and rare minerals in your economy, it serves you well. And if you don't, you need to partner with another economy in order to gain those advantageous benefits. Now, on this chart, you can see that China clearly dominates when it comes to rare earth minerals, particularly when you look at the hard rare earth minerals important for certain aspects of technology. And even by the time we get to 2035, it's going to be very difficult for other countries to displace them. And this is one of the key reasons that we've seen Trump turning towards trying to consolidate power in the Western Hemisphere. It's a resource grab for that area. So, what do Venezuela, Canada, Greenland, Panama Canal all have in common? They either are parts of strategic trade routes or have key mineral resources. And this is essentially the setting against which we are seeing this grab for the Western Hemisphere. Initially, Trump came out to punish the world economy with the big economic stick, which was protectionist policies and tariffs. But he's now started to look towards another big political stick, which is foreign policy. And I think that's largely because the protectionist stick has run its course. It is now starting to hurt the poorest consumers in America, where real wage gains are actually now in negative territory. And Trump knows he needs the support of these voters when we go into the US midterm elections in November. So, as a result of that, we're seeing a bit of a change in tactic out of the US administration with quite a big focus on foreign policy. And again, that global operating system that we're rebooting, quite cognizant of what actually happened in the past. So, again, almost going back to that 1.0 version of the Monroe Doctrine, which was essentially a period in 1823 where a group of American leaders came together to say that we need to become more interventionist in our own backyard and consolidate power here. And we don't want European influence or interference, and we will do the same for Europe. And so we all heard that speech by J.D. Vance at the Security Council last year. And very rightly so, because the US has actually paid about 60% of that NATO funding, even though there are 31 other countries. And under the so-called Trump doctrine, or Monroe Doctrine as it's been dubbed, they are wanting to move back into that age where there's very little European influence in America, and they start to consolidate power in their own backyard. The rise of the rest, and this is really referring to the middle powers. Now, by its very nature, middle powers don't have the same economic heft and military stance that your superpowers do. However, the global superpowers need the middle powers in this new world order because they have something that they want. It's either a strategic trade corridor, some political influence, a big population like India, or mineral resources and energy, which we also know is very critical for the AI boom. And so we're starting to see a bit of a shift in the economic center of gravity to a world where middle powers are starting to gain in prominence. Now, if we had to look at the period between 1946 and 1960, this was essentially a period in which Western democracies did quite well on the back of those industrialization gains. So they really dominated in tech, in GDP, in output, in labor, in ideas across the global economy. But if we have to go back to the global operating system in 1.0 back in 1820, you'll see that the influence from emerging markets was quite big. Fast forward to today, and you can see that the influence of those economic titans are now coming back. So this new world order looks a little bit like the old world order. And this can be clearly illustrated in a picture called the Valle Reprieris Circle, which is a small circle on the surface of the global economy. It makes up about 2% of the total surface, or 8% if you just look at the land mass. And the importance of the circle is that there are more people living inside the circle than there are people living outside of that circle. We've got the Strait of Malacca that runs through that. That's almost like a key jugular vein of the global trade route system. And we've also got some heavy economic populations here. So the Bangladesh, Indonesia, China, India also residing here. So we were in a world economy that got very used to wealth being embedded in the Atlantic. but that key focus is now shifting to the Indo-Pacific. We know that this circle represents quite a large number of people, a very small part of the world economy, but it definitely punches above its weight in terms of its economic heft. What has yet to catch up is that people still need to get richer on a per capita basis, and this is likely to continue over the next couple of decades. Now, if I was standing here a year ago and I was going to tell you that we are probably going to have the highest tariff rates that we've had since the 1930s, which we do now based on the data in this chart. And if I told you I think economic growth in 2025 is going to be 3.3%, I probably would have been laughed out of the room given the negative impact on protectionist policies and what they can do to overall economic growth. But we actually saw from the International Monetary Fund that growth is likely to have printed at 3.3% last year, in spite of the protectionist policies that came about. So the death of globalization has been greatly exaggerated. If we look at trade as a share of GDP, this ratio has gone basically sideways since 2008. It hasn't collapsed in a heap. Why is this the case? So we did have a big pickup in the rise of protectionist policies, but at the same time, we also had a big pickup in the rise of trade liberalizing policies. And so this was really a kick that the European economy needed from America. We've seen old trade agreements that were started 25 years ago, like the Mercosur agreement, now being dusted off and re-looked at. We've seen that India has done 4 key trade deals in the last year. We've seen that China is also starting to reorient their trade. So foreign direct investment in China in the first half of last year has now surpassed the US for the first time historically. China also found a bit of a loophole. And so essentially, Americans were importing Chinese goods that went via Vietnam, Bangladesh, Kazakhstan, just to have another label added. And it came in with a different passport, but didn't come in with that Chinese-related tariff. And this is why China still managed to grow at quite a healthy rate of 5% last year, with one of the key economic drivers being export growth. Many investors continue to argue about whether or not America has retained its exceptionalism. I think they have in a sense, but it is evolving and doesn't quite look like what it used to in all senses. From 3 aspects, I think America is still leading. Number 1, on dollar dominance. Now, we've all heard about dollar de-dollarization, and that is true when you look at the global foreign exchange reserves that are held by central banks. The dollar made up about 70% of them at the turn of the century, and today it's sitting at around 56%. But at 56%, it is still the largest chunk of global foreign exchange reserves. We also saw over the course of last year that the US dollar and the US Treasury didn't typically react like the normal safe haven asset class that it used to. But that's not to say that investors around the world have lost faith in all US assets. And so the chart on the left shows you foreign holdings of various US securities, and the red line is Treasury debt or US Treasuries, and you can see that has come down. So in 2008, 1 in every 2 treasuries was held by a foreigner, and today that has moved to 1 in every 3. So they have sold out here. But when you look at some of the other colorful lines on there, you can see that foreign purchases of other US assets have actually held up relatively well over this period. On the right-hand side, you can also see that the US dollar really does punch above its economic weight relative to the world economy, above its trade weight to the world economy. Outside of its holdings of foreign exchange reserves, between 88 and 90% of cross-border transactions globally are still done in the US dollar. For countries that have externally denominated debt, a very big chunk of that is still dollar denominated rather than euro or renminbi. So unless we find an alternative that has the same legal enforceability, scale, or depth, I do believe that the dollar will remain the world's reserve currency, although we are going to see a gradual depreciating dollar over time as the dollar loses its independence and markets lose the credibility of institutions in America. We have, of course, seen quite a big move into gold, but I think this is more of a hedging rather than a replacing story. And so when we look at gold reserves, we know that central banks around the world now hold more in gold than they do in US treasuries. On this chart, you can see that most of your developed market central banks have quite a big holding of gold already. And the ones that have to catch up are essentially your emerging markets outside of Russia. Now, between 40 and 50 is your level at which having more gold is not going to benefit you from diversification. But you can see that that red line is still quite a ways away from that 40 mark. So that means that there is some structural foundation and underpinning to support gold in the next while. Secondly, America is still exceptional when it comes to their military prowess. So most countries can have a war with their neighbor. They've got enough military and defense systems to do so. But America can have a war with anyone because they've got a presence in 90% of the world's locations. And that's what they call the lily pad military formation. And so they've got a key lead here. America is set to spend between 840 and 850 billion US dollars. That's nearly $1 trillion US dollars just on defense and the military system. This is equivalent to the next 8 to 10 economies that are spending on military in the world economy. So they still have quite a big lead on the military side. And we've seen that out of America, they are now taking a far more interventionist approach in their own backyard, but they're taking a far more transactional approach with other countries like Europe or China. The third element where America is still exceptional is around its key innovation engine. Its university graduates, its outcomes on biotech, space exploration, and of course, software. And when we look at software spending for the US for 2025, the US comes out as number 1 here. The next one in line is the European Union, and they trail by quite a bit. Now, of course, we know that the biggest IT supplier to the rest of the world is India, but on this measure, they only come up as number 8. Democracy in retreat. Now, we've seen that there are more and more populist leaders that are in the driving seat in many of the world's economies. Along with that has come some political interference. So we were quite used to a world in which we had the invisible hand of government, but we've now moved into a world where we have the very visible thumbprint of government. And this is government intervention starting to come and take root in economies like America, where institutions had very deep-seated democratic norms. And this is essentially what made developed markets a safer bet than emerging markets. This concern is now starting to creep through and starting to taint the nature of America and assets there being safe haven in nature. We've seen that Trump's agenda and the scope of it has just expanded, where executive control has now whittled into all facets of the US administration. We're seeing quite a big, heavy hand in areas such as the Federal Reserve, the Treasury, civil justice, even the media. And this, of course, has been one of the reasons that the US dollar has continued to depreciate. A quick note on the Federal Reserve, because I do believe that independence for the Federal Reserve and central banks in general is very critical. So their key mandate is to protect employment outcomes and to ensure that they protect purchasing power for consumers. But if you are wearing a political hat, it's quite difficult to make those decisions. So will you actually raise interest rates when inflation is getting out of control? Probably not, because that's going to make your shorter-term growth outcomes suffer. But of course, in the longer term, your consumers are worse off. And so this is really why we do need Fed independence. I do think another check and balance is coming into play, and that's going to be from the bond markets. And we saw a little bit of that with Liz Truss in 2022, and again with the tariff issue in April of last year. Bond markets are saying you can no longer kick the debt can down the road. We are going to demand a higher premium. And so going forward, I think we're going to probably have scarcer capital, more expensive capital, and capital is going to become far more discerning between the good credits and the bad credits on an economic scale. Now, usually you would think that people that live in an autocratic society probably don't trust government all that much because of issues around transparency. But this chart shows that it's actually the opposite. So people that live in a democratic environment actually have the least amount of trust in government. Again, because those democratic benefits have not infiltrated to all citizens. We're also seeing that the institutional issues embedded in America's key institutions is becoming a key factor in financial markets. And it's not just the Democrats that believe that there's more political interference in the key 9 institutions in America. You're also seeing a loss in confidence from Republican voters. So, where to from here? I do think that globalization is not quite dead. The world is reordering, and we are seeing a reorientation of trade. And in that world economy, there are 4 key scenarios that I think can play out. The one that I think has the highest probability is a managed multipolarity. So we've got different poles of power, middle powers also benefiting from this new world order. The dollar remaining the world's reserve currency, but because of political interference, starts to depreciate at the margin. It's an environment in which multilateral institutions realize that they have to change because domestic policies need to align with multilateral goals. It's a world economy in which growth continues to chug along, inflation outcomes are reasonably moderate, and so are your policy decisions. The second key theme is divide and conquer, where we have 2 key poles of power. So that US China nexus coming back into play. It's a very volatile environment, and we have to actually choose sides between a US and China. But this one will have the most touch points with geopolitical risk. Global fragmentation, we have, again, multiple poles of power, but different currencies operating, a very volatile environment. Inflation gets out of control, interest rates have to go higher in some cases, and of course, then growth suffers in many jurisdictions. And then a sudden crisis is something like a hard landing in China, or the US fiscal cliff finally gets reached. And this is something that happens quite quickly over the period of time. And something like gold would then be a key base for a safe haven currency. So, how do economies play in this kind of world environment, this new world order? Strategic plurality is something that's going to come up more and more. Now, I think we often think about having, one relationship with one country for trade and security and benefits. But look at in India. They champion the voice of the global south. They're going to host the G20. They're part of the BRICS alliance. They have a key relationship with Russia on energy and the military. They're starting security deals with America. And this is essentially the world economy that we are going to play in, with power politics really firmly coming to the fore. Lastly, how do we invest in this kind of world? We're going to see far shorter, sharper cycles, more volatility, an environment for stock picking. Diversification, very key in this kind of climate. We also think that real assets will benefit in an environment where inflation is continuously questioned. So infrastructure, raw materials, especially in a world where resource imperialism has now come back to the fore. We also think about things in terms of themes. So, military or energy, rather than just looking at it from a US versus Europe call. And then lastly, on higher debt burdens, I do think that capital is going to become far more discerning. So it's very important for a country like South Africa to get our economic reform chugging along, to get our fiscal house in order to attract those flows in a competitive global environment. I've got one final slide that I'll just leave up here, hopefully to prompt some questions. I thank you for your time.
In your presentation, you talk a lot about America, and in fact, it's so hard to determine what's America and what's Trump. So American policy, Trump policy seems to be exactly the same thing. What happens post-Trump? Is the US strategy going to remain the same? Do we have to, is JD Vance and Marco Rubio also just going to carry on with Trumpism?
I think, Ray, that's a big question in the room, because we think a lot of the policies have come with Trump, but it's policies that the people in America want. We've got a highly polarized society in America. And in some cases, both Democrats and Republicans believe that what Trump is doing is right. So both Democrats and Republican parties don't like China. So an anti-China stance is likely to persist. Controlling the Western Hemisphere, we saw quite a lot of support from Democrats as well during the Venezuelan issue. So I think some of these policies will continue even beyond Trump, simply because of the extent of polarization that we're seeing in America. I think in some cases, some of them will soften, like the transatlantic relationship between US and Europe has been, a long-standing favorable agreement between the two. This, of course, came under pressure with Trump. And I think post-Trump, we may see a little bit of backtracking on that.
Okay. And what does it mean for emerging markets? Where do we fall in? And especially, I suppose, South Africa, given the fact that we, for some reason, are not liked by the Trump administration. What does all of this mean for us?
So I think we need to really accrue the benefits that we've already started putting into place. At the back end of last year, a number of issues started to come into favor for South Africa, getting off the grey list, getting an upgrade, some structural reform momentum, inflation volatility coming down. This is the era in which middle powers can actually hop onto the bandwagon and ride the economic gains. And I think India is firmly positioned to do so. I do worry that our foreign policy stance is lagging. And so even if we do get our domestic priorities sorted out, we do need to showcase a bit more prowess on the foreign policy front, because this is an age of power politics.
And I see there's a question. It's one of those yes or no questions that economists don't like asking. It's from the stage, from the audience. I'm going to ask it, but I don't expect you to know the answer. You mentioned that the US dollar is, whilst it's waning in popularity, is going to remain resilient. And then you also said that gold is going to continue. The demand for gold is going to continue as different treasuries start stockpiling. The question on the screen is gold a bubble? Apologies for asking. Yeah.
So I'm going to be the typical economist and not give you a yes/no answer, but it does depend on the time frame. So can gold get to 10,000 in the very short term? I think less likely. In the longer term, because these are structural issues for emerging markets want to mop up more gold because of that weaponization of the US dollar. The Bank for International Settlements says that when you get to a level of 40% or 50% of your holdings in gold, there's no more diversification benefits thereafter. And so I think that's what's going to keep a lid on gold prices further down the line. But the chart I showed you with the red line on where BRICS holdings are, it's somewhere between 10 and 20%. So it still has a way to go on a structural manner. I think obviously you'll get these short-term pullbacks as retail investors now sell out, etc. But this is more of a structural argument.
Okay, cool. Now, at the beginning, I mentioned our partnerships with various asset managers, and one of them being almost 100 years old. Robeco is a leading global asset manager that was founded in 1929 in Rotterdam. It's known for its deep commitment to quantitative investing, rigorous research, and sustainability. They manage the Curate Global Sustainable Equity Fund and the Curate Global Emerging Markets Fund. Both funds are available in the dollar fund or foreign currency fund for dollar. I think sustainable is also available in the pound fund and also in feeder funds for rand denominated clients. And they use a process called enhanced indexation. That process, that means the funds leverage off signals including value, momentum, quality, sustainability, and analyst revisions to build smarter, more efficient portfolios. And this is what has helped them outperform in the near term, and hopefully will continue to outperform going forward. To help me explore a little bit more about Robeco, I'm privileged to welcome the CEO of Robeco, who's visiting us from Amsterdam. Karen van Baardwijk is here to join us today. Please join us on stage. When we heard Karen was coming, we decided to put her on stage and ask her a few questions. But before I do, I thought I'd tell you a little bit about Karen. Karen is currently the Chief Executive Officer of Robeco. She's also the chair of the executive committee. She joined Robeco in 2006 and has had several positions in senior leadership at Robeco, including Chief Operating Officer, Deputy CEO, Chief Information Officer, and Head of Operational Risk Management. And she became CEO in January 22. Karen also serves on a number of boards across finance, education, and I'm happy to see the arts too. Thank you. Just reflecting a commitment to long-term thinking and a diversity of perspective. Welcome, Karen.
Thank you very much, and thank you also very much for having me today. And actually, 2026 marks an impressive milestone for us because it's our 10-year anniversary of working together and our presence here in the African markets, and more to come, but it's a great time for us.
Thank you. We actually had a conversation about that earlier with some of your team members, and we look forward to it.
Great.
One of the questions that we wanted to check with you, or to ask you whilst you're here, is, given everything that Sanisha mentioned today, there's a lot of complexity in the globe, particularly in the markets. And for asset managers, how do you adapt to this increasing, I suppose, complexity and geopolitical situation that we are seeing currently in the market? And what is, from a Robeco perspective, how do you guys adapt and adopt to different, I suppose, geopolitical issues that you see?
Yeah. I think Sanisha did an amazing job painting the picture of the world today. So that's the part I will not repeat and skip. But I think given the fact that we live on the same planet, it's one globe, but to look at it from pure globalization perspective, I think that is going to be very difficult. We see with all of the events that are happening in today's world that we need to adjust, and we need to make sure that we can deal with all these differences that influence financial markets, influence our operating models as asset managers. What I find very important to mention is that in a world, whether we talk about polarization, it's extremely important to know that there's not a single company that holds the lens of the world. I think it's extremely important to balance where we sit in the world depends our views and drives our thoughts and ideas, and so does our clients. So I think it's important for an asset manager to really be cognizant of the fact that there is not a single truth. Whether you like it or not, there are different perspectives, and it's up to us to accommodate those various perspectives. So I think that's crucial. The other part is for asset managers, specifically in today's world, is of crucial importance to know who you are. So this is about our corporate identity. I think it's important to speak up to what you believe in, to your strengths, and who you are in this world. Where do you want to play for who in which part of the world? To be outspoken about that, to be in line and in sync with that corporate identity is clear, because this is also where credibility in your leadership starts. I think one of the important things for asset managers is the topics of flexibility, adaptability, and resilience are words that I think we read in many, many of the papers and white papers. But what it actually means and what do you do with this and how do you implement that in an organization, that is very difficult. And again, here there is not one solution. But what I do see is across the value chain of asset managers, it's very important to see how can I design for flexibility? How can I design to be resilient? And what choices then do I make? So for us, for instance, it is clear who we are. I'll get to that a little bit later on. But also to know where our strengths lie. You mentioned this in the quantitative space. One of the taglines of Robeco is being the investment engineers with close to 100 years of existence. That's a core strength of who we are. So that is also something that we continuously invest in. But it's also about the diversification of a platform. It is not one specific investment capability. It's also next to quant about the fundamental space. It's about sustainable investing. So to have a diversified platform from a capability perspective, from a distribution channel perspective, from a client-based perspective, from different geographies, I think is very important in order to play to all of the regional differences. I think the other part is also the operating model. And as you nicely introduced me as a former COO, I love the topic of operations and technology, but also the operating model and the choices that you have to be flexible. So for Robeco, that meant that a couple of years ago, we decided to fully outsource everything past trade execution to a larger platform where we could lift off their technology spending, where we are more flexible. And sometimes that means that my bill grows, but that's a happy problem to have because that means also my business is growing. But in more difficult markets, this means that my bill is dropping. And that type of flexibility in today's world, we need as well. So to summarize, what is the important part for the asset manager? Clarity on who you are in this world, not hold one lens of the world, take regional perspectives, think about your operating model, but also think about how you plan. and how you structure. For instance, for Rico, that meant we had 5-year strategy execution plans. 5 years is a long time in today's world. So I felt the need to shorten that. At the same time, then there's the risk of shortism, and that's for an asset manager not good. So I spent time with the team to define our Northern Star, corporate identity. Who are you to who in which part of the world? Where do you want to play? What is your strength? What are your targets? Where do you aim for? And actually to drive that execution along the lines of 3-year execution plans to get there. So I think also the planning cycle and how you do that is important to really give topics like resilience and flexibility hand and feet.
Okay, thank you. And as you mentioned, you offer a fundamental. We specifically looked at Robeco in terms of enhanced indexation, and one of the things we loved about you was the fact that you were one of the leaders in sustainability, which is crucial for us. And you see why our fund is called the Curate Global Sustainable Equity Fund. I suppose the question for you then, if you look at it from that lens, how is Robeco's approach evolving, and what trends stand out for you at the moment?
Yeah, I think there were similarities in the answer to the other question. I think for us, sustainable investing is something that is very close to the heart. It's part of our DNA. We have been doing this work ever since the 80s. So when the hype, I would call it hype, everyone's just jumping on this topic. For us, that was a continuation of something that we already strongly believed in. But what we do see also based on climate surveys that we issue with global investors is that, yes, we see a dispersion of commitments to net zero alliances, to climate commitments. It's very different. So for us to, again, not hold the lens of the world, to not be driving one single truth, to not be normative, but to work with our clients to see where can you put the lever between risk, return, and sustainability is crucial. So for us to understand where is the appetite, where is it not in today's world, how can we use all of the building blocks for ourselves? And how can we make sure that we create investment solutions with SI inside for any client across the globe if this is what our client wants? So I think it's important that SI is something that for us, we can only stay on course because it's part of who we are. I think one of the things that is interesting for us, it is important to monitor what is the dynamic around sustainable investing globally. So we've mentioned military expenses, we've mentioned defense industry. So for us, it's crucial to monitor, to also see investment opportunities, keeping in mind exclusions, keeping in mind what you strongly believe in yourself. And for us, that monitoring also led to widening the definition of weapons, weapon-related or non-weapon related industries to optimize along that definition to create optionality and choices for clients that work with us. So I think the topic of SI is one that's being talked about a lot. But the other part I wanted to mention on the climate survey is that it is not a fallback that will not recover. It's merely pacing or temporary slowing down, basically because the problems of the world have not been solved and that there are enough, I would say, investment opportunities if we invest in companies that move along the lines of changing their business model and adapting to the new world realities. So for us, staying on course.
That's good to know. That's why we selected you.
Yeah, great.
If I just go back to quant investing, and we chose enhanced indexation as the approach that we would like you to manage for us. There's some people, and you'll hear some of the speakers. We'll hear some of the speakers today talk about how active versus passive. Where do you see quant investing go over the next 5 years? And should people be switching now across between active and passive, or quants per se?
I think if you look into, well, of course, the rise of passive, the rise of alternatives, this is something that's been going on for a long time. But what I do see for us, we are pure active players, and my colleague Jan is going to be on stage later on to also talk about one of the offerings that we have, where we talk about semi-passive or solutions, low light tracking error solutions that are close to passive. But for us, it's all about active asset management, because here we believe we can customize. Here we can believe we can use the IP across the broader investment platform. We can use our SI IP into client solutions that you absolutely cannot do on the passive side. So I believe the need for customization that will drive, again, also the interest in active asset management. And I think quant, I'll leave that up to Jan to discuss, but is in that sweet spot of where appetite today is.
And I agree. I mean, we have lots of conversations with our clients and we talk about enhanced indexation, and everyone feels that it is or thinks that it's similar to passive, or it is passive, but actually it is an active way of managing assets.
Yes.
And for us, it's particularly why we chose Robeco to manage our sustainable equity funds. And next up, I will actually ask Jan to come up and tell us a bit more about that. But on behalf of all of us here at Curate, we'd like to thank you for joining us today. I know you're missing us on Friday in Cape Town, but your next trip, we can definitely.
Next time.
Yeah,
Absolutely. Thank you very much.
Thank you.
All
Thanks,
right.
Gary.
Thank you.
Yes, thank you. And in fact, I think what Karen did is a perfect segue into our next speaker, Jan de Koning, who's also from Robeco. Today, Jan's going to showcase how quantitative investing works, particularly with a focus on the two funds that I said they manage for us, enhanced index funds, the Curate Sustainable Equity Global Equity Fund and the Curate Emerging Market Fund. Jan, thank you.
In financial markets, patterns are everywhere. However, not every pattern really matters. Only the patterns that can be turned into performance you want to focus on, right? And today, what I would like to do, what I would like to show you, is how Robeco systematically identifies, analyzes, but also transforms hundreds of these type of patterns into signals, into an investment process that's very disciplined, and it has yielded, since we started in 2004, very significant, strong and stable risk-adjusted returns. And these returns are not there because we chase the latest market noise. No, we're not doing that. The returns are there because we uncover those patterns that endure and are manifesting themselves in developed and emerging markets. And there's something very powerful about these patterns if you follow them, right? Because if you follow patterns that work, what happens is that performance compounds. And if performance compounds, trust compounds. And if trust compounds, assets compound. So we started in 2004 with our first little, although it was a few €100 million, I have to say, mandate for a Dutch institutional investor that believed in this concept of capturing patterns and turn them into performance. And now fast forward to today, quant investing has grown significantly. It's one of the largest capabilities at Robeco, and especially within the quant space, Ray was already referring to it, enhanced indexing has been a very clear growing asset category for us. So, enhanced indexing, what is that exactly? Well, I believe many of you know it, so I will really briefly give you a refresher what we believe that enhanced indexing is. We all know the success of passive, but in our humble opinion, you can do better, right? So passive investing to us is, great. It gives you access to very diversified portfolios, available at very low cost, highly liquid as well. All great, and we basically tick the same boxes. We also build very well diversified portfolios available at relatively low cost. But passive is passive. You just replicate an index. You don't use any IP, any knowledge. And in today's world, with all this knowledge that we have already for decades, it's a bit of a pity that you don't use it to your own advantage, especially if you're a long-term investor. So what we do is that we're not replicating an index. No, we just look at all the constituents in an index. We judge them on their alpha capability. So do you want to own them a little bit more for the next 9 to 12 months, or maybe slightly less? So we basically tilt that portfolio, that index, towards a more enhanced index. And along the way, why only focus on alpha when you can also integrate with massive amounts of data sets, sustainability dimensions? So that's what we're doing, and that's what we're doing also for Curate. In the enhanced indexing portfolios, we lower the carbon footprint by 30%, we lower the sustainability risk by 10%, and also focus on water and waste reduction, and at the same time, give access to alpha. Right, so that's basically, in a nutshell, in a minute or so, what the concept of enhanced indexing is. And why does this work? Well, it's the power of repetition. So if you rebalance such a portfolio every month, then performance will compound, and then you get a better return, basically, than a pure passive portfolio. So what is behind enhanced indexing? Is it that we basically judge the market in a good way, make a big call on a certain region, right? US or not, maybe not today, right? Or certain sectors? No. These are many, many trades that we're doing. So in fact, our longest running strategy, where all the Robeco employees are invested in, our pension money, yeah, we calculated that we've done over 20,000 different trades. So all these little trades compound and deliver the alpha. But yeah, I have to be fair, is this really the root of the alpha? Is this really, the reason that it creates it? No. We do transactions, buying and selling. And we do this transaction because an algorithm tells us, based on a lot of signals, and signals are just patterns put in some, quantitative language, they show us that there's alpha. But what is creating these patterns that we try to turn into performance? Well, ladies and gentlemen, that's us. That's you and me acting on the stock market. Because these financial markets that give us performance patterns, they exist because human behavior hasn't changed in 1,000 years. Whether we like it or not, emotions, behavioral biases, opinions, they influence our decision making, right? And not only the retail investor, no. Also professional investors have their emotions and take them to work. So what's the best way to deal with all these emotions? Well, of course, as an investor, you need to keep them at bay. Preferably, you don't take them to work, of course. But yeah, we're human beings, right? So you integrate them and they're part of your conscious decision making, right? Or subconscious decision making. So the best way to deal with this, basically, is to use an algorithm, a computer, a systematic approach. In other words, a kind of more a robotic type of targeting these type of signals. I'd like to stress to you that an algorithm approach can be very helpful because try to perform as an analyst 2,000 calculations in a few seconds. It's virtually impossible, right? Try to read 10,000 analyst reports before lunch. Impossible. Machines can do that. They work day and night. They don't complain. They don't ask for salary increases every year. So it's from that perspective, I think Karen agrees with me. It's quite a nice approach. But I'd like to stress here that it's not human versus machine. Totally not. Because I will show you also in a minute that at the end of the day, you still need humans to come up with ideas. Even in the age of ChatGPT, AI tools, you still need humans to come up with the ideas, to really execute the research. And also, when you come across clear signals and you want to implement them in portfolios, also a portfolio manager, it's very helpful that a human being makes a judgment call because the computer can't always make the best judgment call at all. So human to machine is our approach here. And maybe it's good that I shed a little bit of light on these type of signals that we're using because we've turned over the 2 decades that we have live performance. We turned many of these patterns into signals and we give clients basically access to these signals. And yes, I'm Dutch, so of course we love value, like a lot of other humans, buying things, on the cheap, buying $1 for 50 cents. It's a concept a pattern that has proven its value over and over again. And as you can see in this overview, a lot of these signals are orbiting around the concept of value investing. So we look at indeed balance sheet data, also, of course, income statement data, but more importantly, we look a lot to the intangible data because, in this new era where we're living in with asset-light companies, good luck with only focusing on real balance sheet numbers. So we love value, but maybe even more, we like quality. We like firms that have very strong management that carefully looks after the interests of their shareholders and are able to grow their earnings over time. And something I believe that really stands out for Robeco in the way that we capture quality is that we don't only look at the hard yardsticks, like, for example, accruals ratios or top line earnings or what have you, right? No, we found out that especially the sustainability related quality signals hold a lot of power, right? So looking more at the softer components of a firm, how happy are your employees? How are you dealing with your carbon in your company, with your reinvestment in your machinery? These hold valuable signals as well for us that we classify as quality. And these are just few examples because Ray was already mentioned it, a few factors, and I thought for a second, oh, there goes my story, but luckily there's still more time for me, Ray. we have many signals residing in these various factor groups. So yes, we like firms that are trading below intrinsic value and that give access to high quality management. But you can find these companies, but yeah, you need money in motion. There needs to be a catalyst to unlock it, because otherwise your money is really not accumulating. And therefore we have momentum. Momentum as a factor, but also analyst revisions and more shorter term signals. But this is just what you see if you look at the fact sheets, at all the materials. But today I promise you to dive a little bit deeper and tell you more about the process behind behind the construction of these signals. So here we go. How does it start at Robeco? Well, first of all, it starts with IG generation. And yes, we have a quite sizable quant research team. We have the largest quant manager in Europe, so over 25 different quant researchers. But more importantly, and I'd really like to stress it here today, is that Robeco is home to some 60 professionals working in our very successful fundamental capabilities. And that's special. That you are a quant manager and that you have access on the same floor to fundamental portfolio managers. And why is it special? Because a lot of ideas that we as quant integrate in our models, we get them by talking to our colleagues at the coffee machine, organize meetings, but nothing beats sitting down with an analyst who covers, for example, Brazilian mining stocks and ask her how does she exactly capture the mode of such a company. Many ideas that we have put to work in our portfolios are there due to the strong collaboration. So quant, yes, you can do that, it works, but you need also good fundamental people for that IG generation. And in total, yeah, you can see we have some 100 research IDs. So next step, what you need to do, because yeah, we don't have unlimited manpower, you need to, of course, prioritize. We need to set a very clear research agenda, which IDs we want to execute and which one we maybe need to park, right? So we do this every year. And the beauty of this approach also is that you don't, let your mood of the market influence your research decisions. No, we really deliberately set a clear research agenda that sets us away from the noise in the daily markets. That helps a lot. And then next, if it's up high on the research agenda, we need to start executing. So the first step that we're doing is a bit of exploratory research. We put a lot of researchers in a room. It's free format brainstorming. We basically try to assess how we could tackle a certain research idea in the most efficient shape and form by looking at academic publications, signals that we may have already, experiences of fundamental managers as well. And basically that gives us a very good understanding of how we should address certain things and how we basically should capture this idea. And that's important because if you take the wrong avenue, well, you're going to spend a lot of research hours and maybe even your weekends to get to a very good signal. So, but once we have these hypotheses formulated, we know a little bit where to look, then we go to the next stage. And that's a very important stage for any quant manager. So if you look to quant managers, really assess them how good their infrastructure is, because especially nowadays, in the age of AI, where there are large data sets, which are sometimes 20 to 4 times bigger than the data sets that we had 5 years ago, it means you need to have a very good, strong cloud-based, AI-ready infrastructure. So back in the days when we started, we did our research on those mainframes, right? Pentium PCs. And then later, of course, we upgraded and we had more fancy, better laptops. And nowadays, thanks to a migration that we did some 5 to 6 years ago, everything is cloud-based. And that's a blast for researchers because it means that you can just upload your IDs, you test them, and in a few minutes, you have your output instead of a few days. So you can imagine that currently a researcher at Robeco has 4 times higher output than they used to have, let's say, 7 years ago, which is magic if you have a lot of research IDs, of course. And this is also important if we connect later AI, but I will give you an example later. Next step in the whole process is that we, of course, need to test IDs. And the beauty, I would say, of our approach is that we not only test data on the US market, it's a bit of standard for quant managers because data is very much available for US markets. It's also relatively cheap. But, if you only see an effect working in the US market, but not for European or emerging markets, well, good luck with your alpha signals. Probably not there, your data mining. So therefore, all our IDs, we test them both in developed and emerging markets. And they need to work in both markets. If not, we just skip it. We start all over again. We basically look at a different signal. At the end of the day, after all these signals are tested, all the research is done, Then we have a committee of very senior portfolio managers, researchers, heads of research that look into the entire research process, challenge people also in the outcomes. And the next, basically, we go to the next step. We want to implement it. But let me pause here because it maybe gives a bit of an impression that this is a very smooth process. The process is smooth and that the outcomes are always perfect, but reality is a bit different. I can tell you that. Life of a researcher is not always nice. And here I can explain you or show you why that's the case. We have many ideas, and sometimes we really think, whoa, this is a bright idea. If you're going to test it, you will see the alpha there. And then what happens? The signal ends up in this signal graveyard. We thought it was a brilliant idea, but we don't see the alpha. Then we need to give it up. Other signals, they might look good, but the coverage might be not that well. What we do next is that we don't put them in the models, of course. No, we put them in the cellar or the fridge, whatever you want to call it, because basically it needs a little bit more, few years to get better coverage and maybe get our hands around it. So ultimately, only 15% of the IDs make it to our models. That's our hit ratio, and we're quite proud of it. In fact, we celebrate our funerals, you could argue, because at least there was a good attempt and a good ID. So here it is. This is basically the entire overview of the investment process behind it, the real ID generation that we're doing there. If everything looks smooth, we implement it in our models. So in a nutshell, and also to summarize it, this is the entire overview that has delivered us the alpha over the years. All the research that is going on that you don't see if you look at a fact sheet, but it's basically the work of an analyst, of a researcher, and a portfolio manager, thanks to this collaboration that we have with our colleagues in the fundamental team as well. But this is very theoretical, I realize. So nothing beats, I would say, a very good real-life example. So I would like to give such an example and share that with you. I put on here a price chart. Maybe somebody already sees which stock it is. It's a stock related to AI. They produce chips. Very popular CEO as well. It's NVIDIA, of course, right? And what you see here is a classical chart formation, you would say, right? There's an uptrend and there's suddenly a dip. And the 100 million question or 1 million question, of course, is should you buy the dip or not? Well, an economist might say, well, it depends, right? And nowadays we also say that. But back in the days, our research and also academic research basically said, look, if you see a stock dipping, so there's really an uptrend and suddenly a price reversal, in some 60 to 70% of the cases, it's okay to buy the dip because the stock tends to bounce back. Well, fast forward to back a few years, we had a and he's still around, bright researcher that said, well, this concept works. It delivered money to our clients, but can't we do it better? Because we now have a very new AI infrastructure ready online platform to test our IDs. And we thought, well, can't we connect this signal to news in the market? So in other words, the hypothesis was, well, if, the stock is dipping, right, in the uptrend and there's good news, it probably, you really need to buy it. And the idea, of course, if there's bad news, you maybe want to stay out of trouble. You may not want to touch that type of stock. And to be fair, we didn't know what the effect would be if there was no news at all. So this was the IDs, and IDs are always simple. The execution is way harder. And for us, it also took some time because, but the big drawback is of news articles, and you can see it if you just get a newspaper or go online to a news website, is that there's always a headline and there's always a story, but unfortunately, it's never tagged like, oh, this is a good story. This is a bad story, right? So, and we needed to connect 10,000 stocks to news sentiment. So long story short, we basically developed our own large language model that basically tries to identify whether a news story is good or bad. And then next, after we've done that, we connected that to the price information of stocks. So fast forward to today, how does this help us? Well, nowadays, yes, we look at the dip, we see that a company is maybe retracing in price, but then we make a judgment call based on also the new sentiment. And the most interesting fact that I'd like to share with you is that, yes, buying the dip when there's good news, formula for success. Staying away when there's bad news, good idea. But if there's no news, then we saw the most powerful bounces. And that got us thinking, why is that happening? A stock is suddenly going down, there's no news. Well, seems quite logical. If a stock is going down and there's no news, it means most of the time there's a forced seller. And if the seller is done selling or multiple for sellers, right, especially in smaller cap stocks, you observe this, then the bounce is very much more profound to the upside. So nowadays, we augment large data sets thanks to large language models that are driven by alternative data sets, so to speak, AI type of signals with existing well-working signals, and we basically get more alpha out of a signal. So that's, a very clear example how we use this in practice. And if people ask me, well, what's your formula to get there? And the only thing I can say is not only show the code, right? Because it won't tell much, but it's basically this process behind it that gets us over and over again these type of new insights. And mind you, this is not easy to do. Of course, you need to have good researchers, but you also should be able to have a very big team that can really spend a lot of time performing these type of analytic exercises. In fact, some 2,000 hours of manpower, human power, we have spent on this project to get it off the ground. And that may sound impressive, and it actually is, I think, but yeah, it's only this signal that we're having here, what I just discussed, is only one of the tiny signals that we have in our models. We have over 50 different signals in the enhanced indexing portfolio that all contribute a little bit to the excess return that we're generating for our clients. So if you think of that, all that work for just the enhancement of one signal, while we also have all the other signals and sum it together, with all the other factors that we have, and their signals are orbiting around that concept, you can understand how massive this operation is. But at the same time, having 50 signals also drives this diversification, and that leads, of course, that we can turn these patterns into performance. Because that's what we have been doing over the years, and we're very fortunate that we can partner with Curate. We started on this journey a few years ago, and here you see the results of the Global Sustainable Equities Fund, where we, of course, with a very low tracking error of a little bit of over 1%, target an excess return and sustainability dimensions. So you get both, right? And you can see that since inception, the performance has been decent. We're very happy with the performance that we delivered, and also the partnership with Curate, and the fact that they deliver to your clients basically a better core allocation than just simply buying a passive or investing in a passive strategy. Not only in global markets, but these models, as said, also work in emerging markets, and these results also speak for themselves. Since inception, we managed to deliver 2% excess return with a very low tracking error. So no big bets in the portfolio, stay very close to the benchmark, repeat this process all over again, and then you turn patterns into performance. I would like to thank you for this presentation. Thank you, Ray.
Thank you. Thank you very much. In fact, what we've started seeing, and I'm glad you ended with the emerging markets fund slide. What we've started seeing is, as Sinisha spoke about, a shift from the large, older, I suppose, large powers to the more emerging market space. The risk and the fear of most clients is that the passive element of it is very volatile, very risky. And when they look at accessing the emerging markets, we've seen a lot of demand for the Curate Global Emerging Market Fund. How does your process, the enhanced indexation, give people a little more reassurance about the volatility in an emerging markets fund like that?
Yeah, so the excellent question, thanks for that. So the beta of the portfolios is 1. So we have the same level of volatility, but from a more, I would say, diversification perspective, you need to have emerging markets exposure, right? Not only because the long-term prospects are way better than the current developed markets, but I think also, and that's what we share with a lot of clients, is say, well, if you just have a passive allocation, you only get the beta return and you have the volatility, or you could choose from getting the beta plus excess return and having the volatility. You can at least pocket some excess return while the markets remain volatile. And we've seen that our models work very well in emerging markets, in fact, even better than in developed markets. And it has to do with the fact that, the US, up till now, at least, is moving in lockstep with Europe. So, it's quite a homogeneous signals that you get out of it. But, the economy and the stock market of South Africa behaves completely different than the stock market of Brazil. And we're 100% bottom-up stock selectors.
Yeah.
So we just enjoy more the benefits of this diversification as well.
Okay.
Yeah.
I've got one from the audience, and it's linked to actually what some of the stuff that Karen was saying in terms of know who you are and stick to your knitting. The question says, Many factors go through long periods of underperformance. How does Robeco decide when to stay disciplined versus when a pattern may have structurally broken down?
Yeah, it's the most important question. It's another $1 million question, I would say. It's super important, and it's super important to stay on your course, right? So therefore, we have this research agenda, and for us, it all starts, all this research with a very clear economic rationale, right? So if somebody has an ID, but it doesn't make any sense, or we cannot connect it to some kind of economic theme, then we're not even pursuing this whole exercise, right? It needs to have a clear economic rationale. So if a factor is underperforming, can happen, right? It's a fact of life. Therefore, we diversified. And what we do is we first check whether that economic rationale is still valid. And if it's still valid, we still keep it in our models. Because the worst thing you can do as a quant manager or any investor is after you designed your process and it's working, and then after a stretch of headwinds, a little bit of underperformance, change your models. If you do that, that's human behavior, emotionally driven mostly, and we know these outcomes are not the best. So we stay on the course, we execute a research agenda, we keep on enhancing variables, we communicate even more with our clients on the performance, but that's the only way that you can survive. And I think these 20 years track record have also proven that approach yields good value.
I'll give you one last one.
Yeah.
It's actually quite an interesting one. It says, in your conversation, you spoke about adding signals to your process. And it says, have you removed any signals, or do you just carry on adding as explained in your process?
Yeah, we've moved signals, not many. Sometimes you have a change in accounting legislation that makes that a variable doesn't make any sense anymore from an economic perspective. Then we remove it. Sometimes we perform research and we stumble upon a very good, strong signal with way better coverage. And then we run so-called spanning alpha tests. So the jargon for looking for the same pattern, whether you already have that in your models. And sometimes we like to make things as simple as possible and only as complex as needed, because we want to have full control over this process. And sometimes we come up to the conclusion that we can take out two variables and replace it by one better one, right? And that gives us also then a better risk control. So it happens, but not many times. I think maybe once every 3 years or something like that.
Perfect. Thank you. Thanks very much, Jan.
Thank you.
Yeah. That's Robeco, everyone.
Yeah, thanks.
For the next session, just before our break, we're going to touch on a topic which is real assets. It's not yet a fund, or I say yet, it's not a fund of Curates at the moment, but it's a topic that's certainly gaining a lot of traction and momentum, given people are looking to diversify, they're looking for inflation protection, and they're looking for other ways of growing and, I suppose, maintaining their capital over time. So I've asked our friends from London, from the Momentum Global Investment Management business, Gary Moglioni and Andrew Hardy, to join us up here. And they're going to talk about real assets as an asset class and where the opportunities are for that in some of your client portfolios going forward. Thank you, Andrew.
Thank you, Ray. Good afternoon, everybody, and thanks for being here. Our business in London was set up back in 1998, originally to run the offshore assets of the Momentum Group. I remember back then, the offshore limits, the amount you could take overseas was 10%. So naturally, the focus was on investing in equities and bonds. But obviously, exchange controls have been liberalized quite a lot since then. Those budgets have increased a lot. So it's been necessary to broaden the opportunity set and think far beyond equities and bonds. However, still too often when we speak to investors and people think about investing outside of their home country in particular, here, but also elsewhere, it rarely gets beyond a stocks and bonds sort of conversation. This is where we think it's really important to actually start thinking about broadening the opportunity set with a particular focus today on the real assets category and alternatives more broadly. With real assets, there's Sanisha's point earlier. She's making the case for real assets being more relevant going forward, particularly because of their better inflation-proofing characteristics. We're not going to talk about a particular fund today, but we want to talk about those characteristics, the assets themselves, and how we go about accessing them. Alternatives is a bit of a catch-all that they're very widely used, but real assets typically fall within that. Now, a lot of portfolios will have exposure to property, real estate, and the like, which falls within the real assets category. But much more broadly than that, as shown here, it includes areas like infrastructure, so transport infrastructure, airports and the like, utilities, energy, transmission mechanisms, as well as health, social, education, digital infrastructure as well. What are the common characteristics of these? One is their physical nature. They're tangible assets. It's an asset-heavy investment, in contrast to a lot of the big stocks that you see in market indices and the like today, which are often asset-light in nature. Furthermore, they're often essentials that we can quite often take for granted. You know, that they're a part of our everyday personal life, working life, and it's easy to overlook how reliant we are on those. On the infrastructure side of things, they're quite often monopolistic or oligopolistic, insofar as, you know, particularly with take a toll road or a bridge or something like that. Often there's only one place that can be, and often they're supported with that monopolistic sort of characteristic by a government concession or contract. And then their financial characteristics, they typically benefit from contracted income. They're typically quite cash generative, pay high dividend yields, and are generally just more stable because of that, because they're often reflecting a necessity. So the demand for them is that much more stable. So as a result, more stable returns, and often with this element of inflation protection in there as well. Necessarily, there always needs to be a lot of supply in this area. Think about population growth driving the need for more of these assets, populations moving or shifting activity type as well. And also in terms of the aging of the assets and the need to reinvest in them. But also changing technologies and changing activity and the like, insofar as there are new categories created within here. So good examples would be renewable energy. Think about wind farms and solar and the like over the recent decades. But also more currently, think about data centers and the huge growth in those, and the huge reliance that we have on those to fuel the deployment of AI, the cloud models that Rubico's process runs off, etc. It's estimated that there's some $7 trillion that needs to be invested in data centers out to 2030, just in that one category. That amounts to about 5% of global GDP. So real assets don't need to be low growth; they can be high growth as well. But then, how is that funded? Depending by category, it varies, but government financing is a large part of that, as well as corporations as well, investing where they need it as part of their business. But then private capital is huge as well. You need a lot of private capital coming into this area. So we as investors can step in and invest where there's an appropriate risk-adjusted return available. What you see here is the funding gap, though, in terms of at the moment, it's projected that there's not enough capital going into this area. So all else equal, it points to potentially good risk-adjusted returns being available for investors. And then this just highlights on the left-hand side, there's good returns on offer here. So it's difficult. There's a variety of different ways that you can try and proxy real assets in general, but not great indices out there. But if you look at the returns from real estate and alternatives, they've been very good there, almost comparable to equities. But I'd caution against just focusing on the level of return in this area, but it's the nature of that return. As I said, they're more stable and also less correlated with a lot of other asset classes that you might hold in your portfolio, and indeed less correlated with the economic cycle and the like. So less correlated returns equals a better diversification benefit, as well as those higher yielding and inflation proofing characteristics that come with it. So well worth considering from that point of view, beyond just the raw return side of things. But on the right-hand side, you see that in typical retail portfolios, there's been a lack of exposure over time. This area has been dominated by institutions who invest heavily here. There's a few reasons for that, I'd say. I think principally it may be a more complex area to understand. Often private assets as well, so they're harder to access. It's not straightforward to do. But also, I'd say it's probably a case of the less sexy, less exciting. Often people want shorter term gains and are more tempted to look towards the equity markets. But there's a lot of reasons to, I think, consider including them within retail investors' portfolios for all of those benefits that I talked about. I'll hand over to my colleague, Gary, who's the real expert in this area, to talk more about the assets themselves and how we go about accessing them.
Cheers then. Right, I've just been told we're running 10 minutes late and I have an accent that's very difficult to understand, so I will speak faster, but you've got to focus more. I'm from Liverpool in the UK, so if you're a music fan, think Paul McCartney, John Lennon. If you're a football fan, think Steven Gerrard. If you're a UFC fan, think Paddy the Baddy. So I'll move as quickly as I can so Ali doesn't kill me. Let's spur the next slide. So what's the benefits of real assets? Low correlation to markets and diversification from equity and bonds. Everybody knows that. And hold them in your portfolio helps to reduce volatility. The strong income generators, most of these assets have long-term contractual cash flows and they tend to distribute them to investors. So strong, long and reliable income. Next, inflation hedge. A few years ago, nobody was interested in inflation. It wasn't a problem. Now it's one of the key things. A lot of these contracts, most of these contracts have inflation hedges built in. So if it's properties, there'll be 1 year, 3 year, 5 year rent reviews, and there'll be inflation uplifts into those contracts. If it's infrastructure, toll roads, etc., inflation's built into those payments again. So if clients are worried about inflation, real assets is a good place to be. And thematics, whether it's AI, whether it's an aging demographics, whether it's energy transition, all of these themes can be captured within real assets. Is everyone still understanding me so far? Yeah? Okay, perfect. Private market noise. So real assets tends to be the home, as Andrew said, of private capital, and retail investors don't get much of a look in. And we understand the reasons why, there's liquidity, etc. But over the recent times and for the near future as well, all these assets are going to grow. The spend's going to grow in them, and they're across all of the different segments: private equity, private credit, infrastructure, and real estate. There's going to be growth. There's going to be more spend, and it's going to go from 4 trillion to 29 trillion in those 20 years between 2013 and 2033. You see private equity is increasing significantly as well. A lot more companies are staying private for longer, so the listed opportunity set is getting smaller. So what about retail clients? How are they going to access this attractive asset class? So in some of our UK products, we've invested in investment trusts for the past 20 years in our multi-asset portfolios. So we've held real assets in retail clients' portfolios right the way through many a crisis, so COVID being the most recent one. So what's the reasons we use them? You get access to these interesting investments that are usually reserved for large pension funds, private equity, etc. The closed-ended capital, that's important. So the manager can raise capital, go and buy property, infrastructure projects, etc. And they don't have to worry that at the next crisis, everyone's going to panic and they have to sell the asset to the bottom of the market, because that's what's traditionally happened when you've put long-term illiquid assets in an open-ended vehicle. So closed-ended is much better. And the share structure can be boosted with moderate leverage. Some have no leverage, some have 10, 15%, some go up to 40%. So it helps to boost return. So the more defensive the asset, we let them go, we're happy for them to have a higher level of leverage in the portfolio. And the other key characteristic is there's a NAV. They value the assets every quarter, every half year, every year, but the share price will move and it can go to a discount or a premium. And that's a bit more volatility, yes, but it's an opportunity just as much as a threat. We're very valuation focused, we're patient, we sit, we wait, and when an attractive asset, sentiment goes against it and the fundamentals are still fine, we buy. And then the last bit is investment trusts have a board, and the board represents us, the shareholder. They talk to us, we phone them up, we tell them what we think, and they're responsible for strategy, appointing the manager that manages the assets. They can sack the manager, dividend strategy, whether the assets are going to be liquidated or sold and the fund is closed. They control all those things, and they work for us, not for the manager. So I'm not going to show you any more slides. I'm going to tell you a story. What I like to do with my children is, because I invest in real assets, I just point them out to my kids. Daddy's invested in that supermarket. That vehicle over there in the airport, Daddy's invested in that. And they don't care, apart from unless the supermarket one, because they think it might get free sweets. But I think it's really good in this type of environment to bring the assets to life. So we can show you loads of slides about the need for real assets and what they are. But what I want to do is I want to tell you about my journey from South Africa. It was a very long journey. I travelled from Liverpool in the UK, which is the home of the greatest football team on the planet. Yeah, there you go. There we go. I flew to Dubai and then flew to Joburg. So while I'm sitting there, all I've got to do is note all the different investments that we have exposure to. So not just real assets, things that we have exposure to. So let's go through that journey as quick, and I'll do it quickly. The day I'm leaving, I have an annual health check. I was due one, and I thought I've got to do it before I go on a long journey. So I went to the local doctors, had the health check with the nurse, all fine. The building that I'm sitting in is owned by a company called Private Health Properties. They own 2,000 properties around the UK and Ireland, doctors' surgeries, walk-in centres, so you get scans, x-rays, etc. And in the UK, it's a good place to invest because this whole market is paid for by the NHS, and the NHS is the UK government, which is backed up by the UK taxpayer. So when I say earlier we're looking for strong, contractual, long-term cash flows, there's nothing better and more reliable than the NHS paying the rent on these properties. So it's an investment we've known for years and years. We've been in and out of it. And last year, there was sentiment was against it. It went to about a 15-20% discount. We bought at an 8% yield. So every quarter, we get a 2% distribution. It's come up about 20% now. It's down to about a 6.5%, 6.7% yield. But that's what we do. We sit, we wait, we know these assets, and we invest them when we can. Come out to the doctors. The nurses told me, eat more healthy, all the usual stuff, more fish, more nuts. But I'm going on a long journey, so I go to the supermarket to buy some crisps. And the supermarket that I'm in is owned by Supermarkets in Curate, which is the second investment we invest in. Similar to the private healthcare properties one, they own 80 supermarkets around the UK. Tesco, Sainsbury's, I don't know if those names are familiar to you guys, and then Carrefour in Europe as well. So they're the kind of best capitalized and best known grocery chains. Long-term leases, just like the private healthcare properties, these are all 20-year leases, fully insure and repair, so it's the responsibility of the supermarket to maintenance, etc. Inflation protection, both of these vehicles have inflation-linked rent reviews. So, and then the reliability is the underlying supermarket chain to pay the rent. And supermarkets are a reliable, dependable store. Some of them have been there for 50 years. They serve a community, and people need their groceries. The way they future-proof it as well from online is they only buy stores, omni-channel stores, which are stores where the back bit is got vans delivering, doing the home deliveries, because that's a threat to some stores, is if you can't function online, then you may be replaced. But these are only omni-channel stores. And these two investments are both now listed in South Africa. So some of you might know them, you might not, but they've got secondary listings now in South Africa because there is demand for these type of assets. People want retail clients to get demand for these type of strong, dependable assets. So the first two you can buy in South Africa right now. Next, I jump on the train. I've got to get from Liverpool to Manchester, which is the home of one of the worst football clubs in the world. And the train that I'm sitting on is leased from a company called Angel Trains that we own. They've got 4,000 trains, long-term leases, and they pay rent. Again, the train lines, everyone relies on. The government will step in when there's problems, so you know that those payments are dependable. Get to the airport, Manchester Airport, look out the window, and there's lots of those strange vehicles that carry your cases, that refuel the vehicle, that charge them. That's a company called TCR. They operate in 240 airports around the world. And we invest in them via one of our investment trusts. It's an underlying holding in there. And again, airports are countries rely on them. Governments will not let them close. And so those payments need to be made to maintain the vehicles, etc., and keep the airport running. As we take off, I look out the window and we're going across the offshore of the UK and we're looking at the offshore wind farms. We invest in a company called Greencoat UK Wind that has about 50 wind farms onshore and offshore in the UK. Generating about an 11% dividend yield at the moment, nearly 12. Well covered, and they're also buying back stock as well because it's trading at a discount. Again, we like discounts as an entry point, and then we exit as it moves back towards NAV. The plane I'm flying on is an Airbus A380, one of people's favourite planes, the double-decker ones with a bar upstairs. We've just exited a vehicle called Doric Nimrod. They bought 7 A380s using shareholder capital, leased them to Emirates over 10 years. Emirates full insure and repair, and then at the end of the contract, Emirates can either buy the plane off them or they can sell it elsewhere, and we're getting about a 10% yield over the long term. And then if you look at your underlying credit risk, it's Emirates. It's an airline, yes, very, very dangerous to lend money to airlines, but Emirates is one of the most stable ones in the world, backed up by a sovereign nation that's got plenty of money in the bank. And then when I land, I can look on my phone, maybe do a bit of online shopping. And we have a company called Chrysalis, private equity vehicle that we own. They were early investors in Klarna. So Klarna, we're getting paying your payments over 3 months, 6 months, or whatever you want to do. And also Starling Bank, which is a UK disruptor bank. I have a Starling card because it allows me to make payments abroad with no fees. They're two investments within Chrysalis, and I can use them for my online shopping. And then finally, the plumbing of the internet. We invested in a company called Flag, and Flag's one of the largest kind of carriers of the undersea internet cables. A lot of people think the internet's just via satellites, etc., but there's thick fiber optic cables that go under the sea. The Russians keep pulling them up to upset other countries when they get upset them. And Flag owns lots and lots of networks of these cables around the world. They rent them for 20, 25 years, and the big demand for this kind of bandwidth is from Meta, Microsoft, really reliable companies. You sign a 20-year contract with them, you know that they're gonna pay up. And then the power. So everything on my journey has been powered by, whether it's been electric, gas, etc. We own Cadent, which is the UK's largest gas distribution network. We own solar farms, wind farms. So all along the kind of the journey, each bit of power source that's being used, we have access to it in one of our investments. We hold about 30, 40 investment trusts. They then have multiple properties and multiple projects underneath them. So for those small group of holdings, we tend to have access to thousands of different projects. And that's why I can spot lots of things that we own on a 12, 24-hour journey. So hopefully I haven't spoken too quickly for everybody. That's my last slide. I'll hand over to Ray now, and hopefully we've caught up on a bit of time. So thank you, everybody.
I'm Andrew Wellington. I'm the founder and chief investment officer of Lyrical Asset Management, and I live in New York. There's a lot of different ways to invest in the stock market. At Lyrical, we're value investors. You can think of us as we're the bargain hunters of the stock market. Some investors like to chase the latest trends or the hot new thing. We sift through the market and look for those stocks that have been ignored or been missed. And as a result, we can get really good businesses at really cheap prices. And value investing is a lot about what price you pay. You could take a great business. You could take the best business in the world. But if you overpay for it, you're gonna get a bad return. All of our investments have 3 specific traits. We summarize this with VQA. Those 3 traits are value, V, quality, Q, and analyzability, A. So it starts with value. We want to buy companies at bargain prices. Buying a company at a fair price gives you an average return. The way we get an above average return is we try to buy companies at bargain prices. That said, I've been doing this for almost 30 years. And every company I bought, I thought I bought at a bargain price. And a lot of them have worked out. And unfortunately, some of them haven't worked out either. So what separates the ones that work out and the ones that don't? What it really comes down to is whether the future earnings of that business end up being about what we expect it to be. So some companies, it's just easier to get it right than others. And that's where quality comes in. One of the most important things in getting the future earnings right is the kind of company you're trying to get the future earnings right about. When we avoid the lowest quality companies, we avoid a lot of mistakes. So that's value, that's quality. The last thing is analyzability. Some businesses are just too complicated. And I don't know if we or anyone else has any chance of getting them right. Things like banks or pharmaceutical companies, they're just incredibly complex. Investing is a business where humans are making predictions about the future. And humans make mistakes and nobody knows the future. It's not about having no mistakes, it's about having as few as possible. And one of the ways we minimize the mistakes we make now is we only stick to the most analyzable companies.
My name is Jan de Koning. I'm a portfolio manager from Robeco and I live in the Netherlands. Robeco was founded 95 years ago, and one of our first directors said every investment decision should be research-driven. And it's still a key philosophy that we apply as of today for managing our quantitative portfolios. Because every single idea that we put forward in our portfolios is well tested in various market conditions various markets themselves, emerging or developed. And it really comes down to the science of investing. But it's not only science, there's also a lot of art around it. Because scientists can make things very, very complex. Put 10 PhDs in a room and you will get a very complex solution to a simple problem. So therefore we understood that it's not only the science, you also should have the art of the common sense that you apply to your research process. And if you marry those two concepts, then you get very elegant quantitative investment strategies that truly deliver added value to our clients. And that's what we've been doing with the quant investment strategy for over 20 years. It also made us one of the largest quantitative managers in Europe. And in our strategies themselves, we combine very well-known signals like value, or the concept of quality firms, or the concept of market momentum, or the mood of analysts by analyst revisions. We combine that into one big stock selection model, also taking sustainability into account, because that really matters and can make a big difference also for your returns. And in the end, these portfolios we manage for our clients in a very risk-controlled, very consistent manner to ensure that we deliver the best results for our clients.
Hello, I'm Mark Baribeau from Janus & Associates, Managing Director and Head of Global Equity. We run a global growth fund for Curate. It's a very exciting product, we think. We like to target really innovative and disruptive businesses around the world for investing. These are game-changing companies. Using innovation, they bring huge advantages to consumers, whether it's meeting unmet need in the marketplace or delivering very exciting new products and services to their customers. It can also be companies that are targeting other businesses with big productivity enhancing applications, maybe developing the next generation of technology that we'll all utilize someday. We like to look for these businesses around the world in a very agnostic fashion. You never know where you're going to find it. It can come from developed markets where you typically have next generation technology developed. It can come in healthcare. It can come in consumer companies with very unique direct-to-consumer distribution models. It can come from emerging markets which have to solve such complex problems for local markets that often big companies can't tackle in the same fashion. And we look for those as well. So the important part of all of this focus is just identifying those unique business models with inflecting profitability, very strong revenue growth, very high return on capital, and doing it in a way that enables us to construct a very concentrated, focused portfolio of very unique businesses. So from that perspective, we like to think this is a great addition to your broad portfolio because we're offering best-of-breed leadership businesses in a very concentrated, focused way.
I'm James Nodler, and I'm a portfolio manager with Evenlode Investment. I look for investments which are long duration and have, well, actually infinite duration, ideally, and which can generate attractive returns ahead of inflation for a very, very long period where you don't have to worry about reinvestment risk, roll risk, anything like that, which can grow as an index on the broader world economy and ideally go a bit ahead of that. So that confines me, well, pushes me towards listed equities, which I think have got the longest durability out there among financial instruments. And then within equities, listed equities, it makes me concentrate on ones which have some sort of hard to replicate competitive advantage. It can be household names like a Colgate or a Diageo, or it'd be companies with more esoteric reasons for existence like an Experian or a Verisk or an Informa. But those sorts of companies have found through my career compelling as investments with a degree of valuation sensitivity built in as well. The single investment principle on which I would never compromise is the quality of the instrument. So it has to be an equity with durable pricing power, and that pricing power comes from that competitive advantage we talked about. When you don't have that, you have so much less security and visibility over the money you're risking, and it's not and something in my experience it's never worked out for me. And you know, one of the great rules is don't make the same mistake twice if you can help it. So I'm very firm on that one. Within the sphere of what we do, what I do, which is long-term investing in compounding equities, a lot of it is resilience when you're going through a market cycle. The reality is that no strategy works all the time. If one did, I think the markets would have puzzled it out by now. And it's having the faith in your own, but also the empirical confidence in your own discipline to stick with it, and having a really clear set of criteria for what matters, what you really care about. Price is a really important signal in the markets, but it's not the only one. And where you make your bread as an active fund manager is understanding when you should really lean on your toolkit of just whatever else you look for, quantitative information, qualitative information, and prioritize that ahead of the price. And that's really hard. So all of this comes down to balance, to maturity.
There is an intersection between art and science, a place where data and research come together with instinct and experience. This is where Curate lies, where the science of knowing what to do meets the art of making it all come together. It's about thoughtful selection, not broad assembly, giving you a clear and considerate place to start. This is Curate, the art of investing.
The first manager to come up is Hugh Yarrow from Even Load Investments, based in the Cotswolds. He is a co-founder of Even Load Investments, and the firm was founded in 2009. Thank you, Hugh.
Well, hello, everyone. It's great to be here. I think I'm talking to you for about 10 minutes, and it's been raining solidly every day in England for the last 6 weeks, so a bit of South African sunshine outside is fantastic. It's also very nice to be in a room of financial advisors and planners. My father was a financial advisor, and he started his business in the basement of my family home, so I sort of grew up above the shop, so to speak. And one thing I really learned from him is that when you're investing with people, you want them to be very clear about what they do, and to do that sort of consistently over a long period of time. And you also want to be able to trust them and to build relationships with those investors. And that's very much what we've looked to do at Evenload. So I have been a fund manager for 25 years. I co-founded Evenload 17 years ago. And we're independent, we're employee owned. And the only thing we do is invest in the shares of quality companies. And we also look to communicate very clearly with our investors along the way. And the two things I want to do today are firstly to explain our approach. There would be no one that would stand up here and say their investment process is to invest in crappy companies. So what do we mean by quality? And then the second thing I want to talk about is that we think the opportunity set within our universe of quality companies at this present time is the best we've seen since we founded the firm about 17 years ago. So the fundamentals of these businesses are very good. They're growing at a good rate. They're spinning off a huge amount of cash, but the market's not interested in them at the moment. There's been these two incredible trades of the last 5 years, and particularly the last 2 years. On the one hand, you've had big rallies in things like banks and commodities. And then on the other hand, there's been this great sort of trade in the US to do with the AI capex boom, and that's left these businesses on very compelling valuations. Now, the guy on this slide is called Pacioli, and he is literally a Renaissance man. He was mates with Leonardo da Vinci, and he lived with him in a flat in Florence. He was also a Franciscan friar, a mathematician, and he wrote the first book on double entry accounting. And in that book, he mentioned the rule of 72, which some of you may have heard about. And if you approximate if you take your annual compound rate and divide it by 72, that is approximately the length of time that your investment will take to double. So if you look at this chart here, it's got 8%, 9%, and 10% a year. Now 72 divided by 8 is 9, so that would mean at that rate it would take 9 years to double, 9%, 8 years to double, 10%, roughly 7 years to double. And I sort of think of myself, or at least my aspiration is to be a 10% guy. So the UK strategy that we've run for nearly 17 years has done about 10% per annum. It doesn't make you the most exciting person at the cocktail party, but if you're doubling every 7 years or so, you double again, you double again, and you've got what Peter Lynch would have called an 8-bagger over 20 years. And the way that we look to do this, and this is the fundamental algorithm as we see it, is we're investing in the shares of companies and we want the bulk of the return to come from those businesses and their performance. So there's a bit of income, and then it's roughly 2% for this global quality strategy. And then we would expect the per share earnings and free cash flow to grow certainly at a high single-digit rate over time. And it's those two elements that get you to that total return. Now, the issue over the last 18 months has been actually the earnings have been growing very strongly, 15% last year, forecast to be similar this year, but the valuations have come down, and that's been a weight on the total return. But that's what's creating the opportunity set today. Now, this is a long-term story. I'm sure you're familiar with the UK company Unilever. I write a monthly investment view. And one of my clients wrote to me, and he'd been to see his grandfather down on the coast of on the south of England, and his grandfather had bought 700 shares in Unilever on the 1st of August 1966. So that was £1,000 at the time, worth £25,000 in today's money. He was quite a young man when he purchased them. He's now into his 80s, and he just put the share certificate in a desk drawer. Didn't do anything with them since then. And you can see a completely different time in the world. The Beatles, from Gary's hometown, had just recorded the Revolver album, and they were about to record Sgt. Pepper's Lonely Hearts Club Band. You can see our Prime Minister, Harold Wilson, at the time smoked pipes. That's how long ago it was. And you can see the Unilever brands here. And I think actually Unilever's been in South Africa since the 1890s, in India, for instance, since the 1880s. So this is a business, and this is how we define quality. We're looking for a durable competitive advantage where it's very difficult for new entrants to come in. We're looking for structural growth that the business can benefit from, and we're looking for a management team that invests in the health of the franchise and the growth opportunities over time. We also have technical definitions of quality, which I won't bore you with. We have, long-term financial models. We have a proprietary software system. We're looking for high return on invested capital, a low capital intensity, and low leverage too. So Unilever has a fantastic portfolio of brands, and it also has this incredible distribution across the world. And I in fact, saw an advert in Nelson Mandela Square in Sanford on Monday for Sunlight, for instance, and you can see Sunlight here, and Lux, and Omo, etc. Now, how did my reader's grandfather do over this period? So you can see the performance of the Unilever shares on this chart. So that £1,000 over that 60-year period compounded at about 10% per annum. There wasn't really any change in valuation, so that was all generated by the fundamentals. And that £1,000 turned into £300,000 just in terms of the capital over that 60-year period, and that's versus that £25,000 in real terms. So a great sort of story of long-term compounding. The dividend today is £10,000 on that £1,000 investment. So again, it kind of reminds you of that long-term ability for these companies to produce wealth for you. And if you think about everything that happened over that period, the two oil spikes in the 1970s, the 1987 crash, you can see a dip there in 98, 99 when this business was less fashionable in the TMT boom, but the compounding has continued. I think the other point to make is, even though it's a good business, no business can stand still. There's no such thing as a perfect company, and the world moves on. You get technological change over time, and Unilever has had to change. It was primarily a food business in the 60s. It's had to keep investing. It's disposed of parts of its portfolio that became less compelling. It's made bolt-on acquisitions, and it's continued to invest in its future. But a great quote here to sum up that basic point in terms of what we're trying to achieve from the father of value investing, Benjamin Graham. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. So if the fundamentals come through, ultimately the share price is dragged along by those fundamentals over time. So in terms of Evenlode, we we work in a very beautiful part of the world. It's the Cotswolds. You can see the river on this photograph, which is the Evenlode River, and we run 3 strategies, including the global equity strategy, and manage just under $7 billion of AUM. If any of you are ever in England, feel free to drop by on the way up to see Gary in Liverpool. It's not far from London, very nice part of the world. And in terms of our process, I won't go into this in great detail, but we do a huge amount of fundamental work in terms of peeling back the layers of the onion to get to know these businesses. And you can see 10 of the key risk factors we look at. And I would just highlight 3 of them that are super important. One is the moat strength. One is so that's the durable competitive advantage. One is the long-term outlook. And one is the cultural quality of the management and whether we feel they're investing properly back into the business. And we score all of these 10 risk factors, and that helps us determine a position size for a company. And if we're not happy with the fundamental risk, we may well reduce the company or sell it. The other lever we've got to pull as active managers is the ESG factor. So we spend a lot of time engaging with the boards and the executive managements, discussing, governance, capital allocation, strategy. And if we feel that a business isn't properly investing in the future, or if, for instance, we don't feel the capital structure's appropriate, it's got too much leverage, we're always giving constant feedback to the companies on that. I think just a really good example over the last 2 years has been obviously this huge change with the sort of generative AI technology, and there's opportunities and there's risks that produces to pretty much any company in the world, and we've done a sort of unhealthy amount of work on that. So we speak to a lot of experts that have worked at companies, that have worked in the sectors that the companies operate in, technology experts. We also obviously talk to the companies themselves, and then to analysts who are experts in the sectors as well. And I think, Christina, my colleague, will touch on this in the Q&A session, but as one example, we think there's been this quite indiscriminate sell-off in companies that have digital business models, and we think there's some very interesting opportunities there for sort of information service companies that have very strong proprietary content. The baby has been chucked out with the bathwater, and we think those are very good businesses that are growing at a good rate, are actually beneficiaries of generative AI in many ways, but are currently trading on very interesting valuations. So then just to finish, valuation is also very important for us, not just the fundamentals of the company. I think this example from Cisco is just a great example because it's a pretty extreme one, in that the price to earnings multiple of Cisco in the late 90s was at 100, and it's an excellent business, Cisco, and it's grown its earnings by 9% per annum since then, but the share price has only just got back to where it was back in sort of 99, 2000, because the stock has been derated over time. And then on the current backdrop, you can see here the discount that the free cash flow yield on the portfolio has relative to the MSCI Global. And you can see it's the sort of cheapest that it's been for the last 15 years or so, but on a forward-looking basis, it's even more extreme. These businesses are spinning off huge amounts of cash, and the free cash flow yield is over 5% for the portfolio. The MSCI Global is only about 3% at the moment. And these are excellent quality businesses. Going back to our definition of quality, thinking about return on invested capital, how profitable these businesses are in terms of gross margins, operating margins, the strength of the cash conversion, and these businesses have low leverage as well. So you're getting a portfolio that's very high quality, but it's much cheaper than the global stock market at the moment. And as I said, the earnings and the free cash flow per share are still growing at a very good rate through this time. It's also a very diversified portfolio of equities. So we've got everything from Nintendo games to L'Oreal skincare to financials like MasterCard, to business-to-business information service providers like Relex, the New York Times, and even Hasbro, what people think of as a toy company, but it owns this very successful franchise called Wizards of the Coast. So a real range of different business models that are contributing to the cash flow. And then just to finish, There's a Mark Twain saying that history never repeats itself, but it does rhyme, although apparently Mark Twain never said that. But I do think there is some pattern recognition with the late 90s. I'm definitely not predicting that the Nasdaq's going to fall in the way that it did in the few years from 2000. But I think there is we're in a period of the market where the sorts of companies we invest in, they're Buffett-like companies, and Buffett was sort of written off as a grey-haired old fuddy-duddy in the late 90s for investing in these businesses that have durable competitive advantages, partly because they were too boring relative to some of the technology shares, and in some cases people were worrying about disruption risk. And you can see here, just as an example, the consumer staples sector was obviously down during sort of 98, 99 in a period when the Nasdaq more than doubled. Now, then, in the next sort of couple of years, the old economy didn't die. These businesses are market leaders that pivoted and invested in the internet, harnessed it for their own businesses. And you can see people were reminded of the qualities of these businesses when actually the Nasdaq had a very poor period. And I think, there's a more general point here. I don't want to mention the R word in a conference like this, but and I'm certainly not predicting a recession, but I think we've only really had one global recession since 08-09, which was the COVID downturn, and it was very short-lived, and it was sort of short-circuited by fiscal stimulus, and then obviously the invention of the rollout of the vaccines. But these sorts of businesses, they do have very repeat purchase cash flows. Going back to my point, they also have low leverage, and they're also self-funding, so they can invest with their own internally generated cash flow. And I think during periods when investors are more worried about downside risks, going back to my English weather and the rain, these companies act as your umbrella in the golf bag. So that's it. Thank you.
Thank you, Hugh.
Okay.
Our next speaker, I think we've heard a lot from this side of the Atlantic, and now we're going to cross the Atlantic, and we're going to have two speakers from the US. The next speaker is Mark Barable. He is the global head of equities for Jennison Associates, and Jennison Associates manages the Curate Global Growth Fund.
Hi, everyone. It's good to be here this afternoon. My name is Mark Barabo. I'm head of global equity at Jennison. We're in New York and Boston. It's always a pleasure to come to South Africa. We've been doing it for years. I'm going to talk about growth as we define it, what we're looking for. We invest in what we consider to be new market leaders. They usually have a unique business model. That's what's enabling their success in the marketplace. They have very strong competitive advantages because they're usually causing a structural shift in their industry. They need to defend that profit pool from a lot of competition. So it's really important that they have a significant edge on their competition. And they're usually founder-led. And as they mature as companies, they'll have different management will take over, and then they become more of an innovative product cycle-based company, but the big disruption is over. And so when you think about our portfolio, it's going to really depend on three key catalysts for growth, the kinds of companies we're invested in. Number one, they're usually introducing something disruptive to the marketplace. Think of Tesla, Netflix, Google in the old days, Apple with the iPhone, et cetera. The list is quite long of these multi-year winners that drive not just performance for those individual companies, but eventually drive the return of the market itself because they become that big. So these are really important companies to get in early. They're not that common, though. So the second most important catalyst for us are just innovative businesses. They've been around a long time, or they're young. They're not disruptive, but they keep introducing new products to the market that are very successful. Consumers love them, and they're able to sustain their growth rate at a low double-digit rate. Not dynamic, not as exciting, but very consistent. Those are also hard to find, but once you do, they can turn out to be really good performers. And then lastly, these companies all, in either category, have expanding addressable markets. They're either moving their success to a new geography on the product or service front, or they're moving into adjacent verticals where they have a high degree of competency because it's adjacent to their core competency, and it just keeps the earnings and revenue growth moving. So that's the type of business we're looking for. Over time, they do become the who's who in the market, so that's great. But they're really dynamic. And why do we fish in that pond? If you look at this chart that's up here now, and if you look at MSCI All Country World since 1997, since the inception of the index, and you just look at rolling 5-year period returns, companies that are generating the fastest growth, the top quintile of the market, generate high double-digit rates of return, high teens. It's really powerful. That second quintile also drives very good double-digit returns. Think of those more of a stable double-digit compounder like an Hermes, companies like that tend to be consumer-branded companies. You could also put Apple in that category today, just a big consumer company. It's not really a tech company anymore. When you look at sort of the market today, there are a lot of interesting structural changes going on. There is a rapid pace of innovation. It seems to accelerate every 5 years, getting faster and faster. The most important of which is generative AI. We'll talk about that in a minute. I think it is the most important part of the market today. It's the one thing you have to get right for the next decade to be successful, we think, in the investment world, because it's going to drive a lot of major disruption across industries, but also major investment opportunities for those companies that are providing the goods and services to do that. So it's a double-edged sword there, so it's going to be very important to get right. But also you have very important things going on in global consumer brands. We prefer direct-to-consumer distribution models. You can only buy the product from them. They tend to be vertically integrated in their supply chain. They control their own destiny. And those types of companies with that unique business model are winning big versus other players. You see in emerging markets, particularly Latin America and Southeast Asia, e-commerce and fintech platforms, they usually go hand in hand because you need one to help you buy something online in markets that don't have a lot of credit card penetration. They continue to drive 30% type revenue growth. And it's early days. It's not like this is an old trade. It began many years ago, but you're finally hitting the S-curve of adoption in big markets that are driving really now strong double-digit growth and franchises that can better fend off competition. And then you have healthcare innovation. It never tends to be a big part of what we do. It's always there. It's probably 10% weight or less. Healthcare has the worst sustainable competitive advantage in the marketplace, because if you do develop a new pharmaceutical product or biotech product, it's going to be chased by hundreds of companies. And it's very hard to defend it over time. But if you're early in an investment where there's a big new product cycle, a few years ago it was GLP-1s for type 2 diabetes and obesity, although that trade is largely over. And today it's just in specialty products where we're focused. But it's a consistent part of exposure in our portfolio, never big, but it can play a really important role because there are unique product cycles going on there. AI is the big one. A lot of questions about this in the marketplace. It's causing a lot of consternation in the marketplace for different reasons. Is the CapEx boom sustainable? Is the seemingly wave of destruction across different asset-light models an overreaction to its potential impact? A lot of questions in the marketplace. But there are ways to monetize this as an investor as you get into companies that are generating huge revenue and profit streams today. Phase one is where it's all the action's been the last few years. That's the build out of this accelerated computing infrastructure, data centers, et cetera. So it's NVIDIA GPUs, it's ASICs from other semiconductor companies like a Broadcom. There's networking companies involved. And of course, cloud-based computing platforms, because all this computation is occurring really on 4 companies, Amazon AWS, Microsoft's Azure, Google Cloud, and then secondarily on other smaller cloud companies. So they're all generating tons of revenue growth right now at very good margin. So you are seeing monetization of AI, but it's very narrow, but it's there. And then there's all sorts of bottlenecks that occur in this build out. Right now we have a massive memory shortage globally, so you're going to see a big capex boom in semiconductor manufacturing, which benefits a handful of companies. You also have electric power demand constraints. So again, you have lots of opportunity to invest in companies supplying the equipment to get this constraint removed. And these are multi-year build-outs. It's not 18 months, 24 months. It's going to be over the next, it's going to really be through 2032 for the power side. But phase 2 is the most exciting. That's what's coming this year. We're starting to see early data here. And that is pure AI applications. I'm sure everyone in this room has ChatGPT. So search is one of the big ones. So far, that's just being monetized by subscription. OpenAI is already at a $20 billion revenue run rate after 3 years. So that's as fast as Google was. Well, it's a little faster actually than Google when it started. So this is it's already a powerful monetization tool there. But you are getting AI agents hitting the market now. That's primarily coming from Anthropic and their cloud tools. It's explosive growth. I'll show that in a minute. Again, big monetization going on now. Early days. These companies are going to come public in the next few quarters, and so you're going to start to see brand new companies hit the market that are publicly traded that are going to be the disruptors, and they're going to be in the big guns like an OpenAI, ChatGPT. It's going to be Anthropic for enterprise tools, but it's also going to be all sorts of verticals like in customer service and areas like that. That's where we spend most of our research today, is on those companies, because when they hit the market, we want to get them in your portfolios. Phase 3 on the edge. It's already being sort of developed in conjunction with. It's not new. I mean, it's not going to be last per se. It's just easier to describe it this way. But you're going to turn your iPhone or your smartphone into a digital assistant, where it'll book things for you. You'll give it a voice command. It'll go out and do it all. Come back to you. Email the restaurant or go on the website of the restaurant for booking. Handle it. Get back to you. And ask you questions about which time you would prefer or not. That's all going to be done without you lifting a finger. And it's going to hit the market this year, next year. It's not like 3 years from now. Autonomous driving, you'll see an acceleration of development there because Gen AI can think like a human, and it's scary. And so you're no longer relying on machine learning or just learning from data patterns on how to drive a vehicle. It can now think for itself and make more intelligent decisions. So it should see a geometric rise in effectiveness. So very exciting. Obviously, the bottom part of this slide is where the real action is for the AI currently. So you have the computing, cloud computing providers, you have the infrastructure layer that's semiconductor based, the hardware, and then you have some software companies that play a critical role in securing the network, because you have the data flows enormous in and out of the network onto a device. That all has to be secure. And then on the application side, as I mentioned, the big ones are coming soon. It's not going to be these old companies. Like it's very unclear whether or not a Microsoft or a ServiceNow can make this transition. You may see a company like Anthropic replace it. CapEx, very controversial because it's so big. So this year, the big four, and if you throw in Oracle, which is a much smaller number, are going to spend now $650 billion on data centers. That's up 80% from last year. So that's huge. That's just really 4 companies. And by the way, they account for over 85% of all global capex and data centers. So they're really all that matters right now. You do have it going on everywhere else, but these guys are powering it. So the good news is, if you look at the blue bars on this chart, it's all being funded from cash flow. This isn't like 1999 or 2000, where the build out of the internet was funded by a lot of debt and a lot of IPOs of sketchy companies. This is just being funded out of cash flow. That's why it's been so fast and so significant. And so I can't emphasize that enough. The speed at which this development is occurring is only possible because these companies have so much money. So it's what makes this cycle unique. I'm not saying different, but unique compared to other capex booms in tech. The reason they're spending so much money isn't because they have a dream. It's because they can't keep up with demand. So anyone who tells you that the money's being spent and I'm very uncertain what's going to happen, that's wrong. They're responding to sold out capacity. All of them, if you listen to their fourth quarter earnings calls, they're sold out. They can't actually grow their business any faster because they don't have the compute capacity. And the reason is the tokens, which is a unit of measurement for computing, is exploding in growth. It's growing at Google Cloud, for example. It's growing 20-fold every 12 months. So that's enormous computing. What's driving it is, so far, you have the single shot chatbot. Let's say that's a 1 unit of a token. And it's a good representation of that, actually, like you doing a simple query on ChatGPT. But if you go to image generation, which you can now do, that's a 10-fold increase in tokens. If you go to simple reasoning, so you want it to actually solve a problem and think through it, that's 100-time increase in the number of tokens. And then if you want to do a 10-second video, which Sora, released by OpenAI, can do, that's a 3,000 times increase in the number of tokens. And then, of course, you go to deep research, it's huge. So the growth in tokens is what we're following closely, because that's the signal of demand from the market. That's not, again, living the dream. That's what the market's telling you demand is, by thousands, or if not millions, of enterprises around the world and consumers. So far, well over 1 billion consumers using it. So very, very important. And that's what's driving the CapEx boom. So I'm going to end it there. I'm sure there'll be questions about this in the future.
Thank you, Mark.
Thanks.
Yes, there will be questions. Next, before the panel discussion, is David Merklin. David is from Lyrical Asset Management, based out of New York, and they manage the Curate Global Value Fund. Thank you, David.
Thank you. Today I want to speak to you about 2 things. The first thing is about opportunity. The second thing is about being sexy. Now, at Lyrical, we believe that the opportunity in the market is to find the gems amid the junk. So the cheapest stocks in the market. And today is a particularly good time to do so. Number 2, being sexy. While the cheapest stocks in the market don't seem that sexy, owning a portfolio of the cheapest stocks, the gems amid the junk, makes for a very desirable portfolio. In the last 5 years, if you had invested in the 20% cheapest quintile of stocks, you would have outperformed the MSCI World Index and the MSCI World Growth Index in a growth market. Now, the opportunity going forward is even greater. We have to look back a quarter of a century to see an opportunity as great as we are seeing today. On this chart, you see in the blue line the PE ratio of the median stock in the universe going back 20 years to before the tech bubble. And the orange line, as you see on this chart, is the PE ratio of the cheapest quintile of stocks, the cheapest 20% of stocks. And on the bottom in the shaded area, you have the difference between the two, the gap between the two. And as you can see, the gap in the fourth quarter of 2025 was 110%. And we haven't seen a gap that wide since the fourth quarter of 1999. And we call it a generational opportunity. And amidst the junk, amidst that orange line of cheap stocks, the cheapest 20% of stocks, you do find stocks that benefit from the latest trends, such as, for example, AI. These are 4 of the stocks that we've owned, some of them for a very long time, even before the global value product, when we had just the US value product. And they all benefited from AI, but we found them when they were in the pile of junk, where no one cared about them. Just to take one example, Broadcom, the top one there, which we have held for 4 years in the Global Value Fund, during that period was up 216%. And that outperformed the Mag 7 by 98%. And when we bought Broadcom, it was at a 13 PE. When we sold it in 2024, probably to a growth manager, then it was trading at the mid-20s PE. Now, I'd like to share a few examples of what we currently own, but before doing so, let's just revisit the lyrical way, for those of you who don't know it, value, quality, and analyzability, VQA. So we search for stocks in the cheapest quintile. That is our hunting ground. But among the cheap stocks, it's usually a pile of junk, so you have to find the gems. So we have a minimum criteria for quality among the cheap stocks, and that is just avoid the bad stocks. Just go for the good businesses among the cheap stocks. And our minimum criteria for quality is at least 10% return on invested capital, because then we can expect as long-term shareholders to make at least 10% on our investment in that company. And that helps us stay away from certain industries, such as, for example, airlines. Airlines have very high fixed costs. To fly from Johannesburg to New York, you need to fly the whole way. You can't fly half the way. And you have to fly with just 2 passengers or 200 passengers. You got to make that route. So very high fixed cost, a very bad business to invest in. We also require our stocks to be analyzable. And that may seem like a natural thing. No portfolio manager would invest in unanalyzable businesses. But we have very high criteria for what is analyzability. We don't invest in banks, for example, because we don't have full transparency of the bank's loan portfolio. And very small loan losses can lead to very big problems for those banks. So we stay away from certain industries. So value, quality, and analyzability are our core parts of our strategy and our process. Or saying it in more simple terms, good, cheap, and simple. Right? Or cheap, good, and simple. But cheap, good, and simple doesn't make for sexy investments. But it is for us. And I'm going to show you a few examples of why, by giving you the lyrical challenge. So in this chart, you have 2 graphs. This is the earnings per share of stock A and stock B. Stock A has grown its earnings since 2007 by 14.8%. And stock B has grown its earnings by 13%. Both stock A and stock B are good businesses. Just to give you a sense of, the market grows at about 6% per annum, right? Its earnings. So they're growing at more than 2 times the speed of the market. They're both good quality businesses. Now, the earnings per share is the middle graph in this chart. You can see 14.8% and 13%. On the top of this slide, you have a chart that shows the price over the last 20 years of stock A and stock B. And you have on the bottom the PE ratio of stock A and stock B. And you're familiar with at least one of these stocks. Stock A is OpenText. Stock B is Microsoft. And as you can see, incredibly enough, OpenText has grown its earnings by 14.8% and Microsoft by 13%. OpenText is a software company, just like Microsoft. OpenText is a $6 billion Canadian business. And businesses around the world have a lot of data. Data about their customers, data about their suppliers, data about their employees, and all of this data has to live somewhere securely. You store some of it on servers, company servers, and some of it can travel in the cloud. OpenText has a software that helps businesses determine what should be stored on company servers and what should be in the cloud, and who should be able to access the data. And let's look at it from a lyrical perspective, how we look at stocks: value, quality, and analyzability. So OpenText is clearly cheap, certainly a lot cheaper than Microsoft, right? Trading at just sort of a single-digit PE, the bottom chart in the slide. And in terms of quality, well, it's a quality business. Its returns on capital it's north of 100%. Great business. Its software is very cheap, but it's absolutely mission critical for the businesses who use it. And therefore, they lose very few customers. Great quality business. And look at how they've invested and reinvested their capital over the last 20 years to grow faster than Microsoft, grow their earnings faster than Microsoft. What about analyzability? Well, it's an extremely sticky software, and it's very analyzable. You lose very few customers, you can analyze that business. So what the lyrical challenge shows you is that you can own sexy tech companies, and you don't have to pay 25 times earnings for them. Let's do another lyrical challenge. Stock A and Stock B again. Here, Stock A, the orange line, has grown its earnings since 2007 at 9.8%. And Stock B has grown its earning at 2.7%. Remember, the market has grown at 6%, right? So Stock A has outgrown the market, and Stock B has undergrown the market. Let's look at it again in terms of price, earnings per share growth, and PE multiples. So again, we have on the top the price of Stock A and Stock B, the earnings per share growth of Stock A and B, and at the bottom, the PE ratio of Stock A and Stock B. And what you notice is that they have the same PE ratio, but which one would you rather buy? At the same price, clearly the one that's growing faster. Well, Stock A is AerCap, and Stock B is the European Bank Index. Now, AerCap is the world's largest aircraft leasing company. It owns about 1,500 aircraft, and it leases these aircraft to airlines at long-term contracts of 8 to 10 years, and then they resell them in the secondary market. And the assets are the physical airplanes that have a clear market value, and the leases are secured by these aircraft. So if an airline doesn't pay, AerCap just takes the airplane and flies it to another client. Stock B is the European Banking Index. Now, we don't own banks. I mentioned that earlier. But many of our clients ask, why don't you? They're so cheap. And they are. So they're also very fragile businesses, which make them difficult to analyze with confidence. And analyzability is key to us. They're fragile for two reasons. The first reason is they require a lot of leverage to earn an adequate return. Tier 1 capital ratio of across all of the large European banks is about 16%. So simply put, for every 16 euros of equity, they have about 100 euros of assets. So very small loan losses can lead to very big problems. And that's the second problem with banks. Because if they do have small loan losses that lead to big problems, their shareholders will sell their shares, and the depositors will withdraw their money, and they will lose the trust of their investors and of the depositors. And when you lose trust of your investors and of your depositors as a bank, it's very hard to gain that back. And we all remember the global financial crisis, and the European sovereign debt crisis, and Silicon Valley Bank, and the US regional banking crisis, and most recently Credit Suisse. And these are all very recent in our memory. And this structural fragility and lack of analyzability are central reasons why we avoid banks. And if this wasn't enough, look at their earnings line, their earnings per share growth, the middle part of this slide, middle chart, at just 2.7%. Well, we chose AerCap over European banks. The last slide is probably the most important slide of my presentation, and it may even be the most important slide of the presentation that you'll see today. It shows you why what we do is really sexy. So the left side of the chart is the PE ratio of our portfolio. And Currently, our PE ratio of next 12 months earnings is 12 times, compared to the MSCI World at 20 times. The right side of the slide shows the earnings per share growth of our portfolio. And as you can see, our portfolio is growing much faster than the MSCI World and the MSCI World Value indices. Our EPS growth is 8.1%. So what we offer is that uncommon combination of a portfolio that's growing faster than the market at a significant discount to the market. And that is a really sexy portfolio. Thank you.
Thank you, David. Thank you, David. And to end off the day, I'm going to invite my colleague, Natalie Harrison, Head of Distribution at Curate Investments, to recall all the style managers back on stage so they can all talk about their different styles, philosophies, where are the similarities, where are the differences. Thank you, Natalie.
When I ever see that slide come up earlier when it's like Natalie Harrison from Cape Town, it's not as exciting as where these guys have all come from. So thank you for making the trip to South Africa. You've already heard from David from Lyrical and Mark from Jenison. So we've got a new panelist, Christina Dyer. She's one of the portfolio managers on our Curate Global Quality Equity Fund, representing, obviously, even though you heard from Hugh earlier. So I've got there's some questions that are coming through on Slido, so please do continue to send those through. But I'm going to start by not talking really about the philosophy and processes really. I think you guys did that really well. I think I'm going to really focus firstly on AI, because what global presentation doesn't have a lot of focus on AI these days, or news headlines, or social media, TikTok, Snapchat. So Mark, obviously being the growth manager amongst the three here on the stage, I'm going to first chat to you about AI. You showed a slide on the capex of the hyperscalers, and obviously the significant amount of money that they're spending. You quoted, I think, $650 billion, which is crazy amounts of money when you think about it, on those four businesses, those top four. Now, the question that I often get, and it's coming a lot in the news, is there a risk that these companies are overspending? I know you said that there's demand through those token growths, but when will revenue actually come through, and at what pace to justify the amount of capex they're spending now and for the foreseeable future? So that's the one question. And I suppose linked to that, any other risks that you're potentially seeing in this AI trade?
Sure. Yeah, no, this is obviously a big debate in the market. It has been for over a year, and I don't think it's going to go away anytime soon, to be honest. So, as I said in the presentation, the one thing we're focused on very closely is demand growth, because if the demand is there and the computing capacity is sold out and they're building more, that's what they should be doing. And we have to trust that the management of these big companies aren't crazy, because they've been too conservative, if anything. They haven't spent fast enough. Amazon's lost a lot of market share. Microsoft is in the process of losing a lot of market share because they're not spending fast enough. So the cloud computing game is a little easier to see, and because you know the revenue growth of those companies. Now, for the real AI companies, so that's where the new revenue source has to come from, the monetization. We are starting to see it finally. Anthropic is now at a $14 billion revenue run rate after just 3 years. That's up tenfold from last year, and that was up tenfold from the year before. So Anthropic's revenue is growing tenfold every 12 months. And $14 billion for a software company, by the way, is huge. Very few have ever passed 10 billion organically. And so this will be one of the fastest growing quote unquote software companies in the history of mankind when it goes public. And it'll probably go public at 750 billion market cap or $1 trillion. So it's big. OpenAI has about 20 billion of revenue, only subscription based, and a very small percentage of users, probably including most of you in this room, well, a very small percentage of users pay a subscription for the premium version. Most people are on for free. And they will start monetizing in 3 areas: advertising and commerce, so e-commerce, and then on agentic tools like Claude from Anthropic. So they're targeting, these are OpenAI's goals. We don't know if they'll achieve them. They're targeting 100 billion of revenue in 3 years. So that's where you're going to start to see the proof. And again, as we meet with private companies, they're getting blue chip customers to sign up for things like customer service, where you're using a chat bot to complete 100% of the customer service interaction with you and me, instead of one of these horrible experiences we go through if you call your telecom company or your cable company, or you call a company that you bought something from and you want to know where it is. This actually handles all of that with linkage to every system involved, including right down to DHL delivery. And so the agents move around all these databases collecting the relevant information and come back and give it to you. And so the customer satisfaction is very high with these new breeds of services. So we're pretty excited about that. So we just need to be patient. So the monetization's already there for cloud computing. The monetization is starting small, but it's already multi-billions from the new software companies, I'll call them. And this is, when the internet was created, nobody knew how to use it, et cetera, et cetera. It was like, you're going to buy a book online, I don't know. And what did we get out of that a decade later? We got the most valuable companies on earth. Amazon, Google, Facebook, Apple with the introduction of the mobile internet, the iPhone. And this cycle is going to be no different. In 5 years from now, hopefully I'm still here, or I will have been really wrong. There's going to be a whole new set of market cap leaders that you're going to be talking about over wine, and they're brand new. It's going to be the next Google, the next Microsoft, the next Apple, etc. So it's going to be very, very exciting.
I suppose, and also, as you said, I mean, if your expectations on some of these businesses are wrong, or the risks are higher than you expect, and that's where you guys come in and you sell and you find a better opportunity in those particular industries. Maybe on that point of risks, I've actually got a slide here that's, someone's actually asked a question also, so it's quite opportune that I've picked this myself. But this is a slide. Thank you, Nick from Jennison, for actually sharing it with me. But it basically highlights the carnage that we've seen in software stocks more recently. And that's really been due to the more recent, I suppose, Anthropic Claude Cowork announcement and some of its plugins, and what the expectations of that, I suppose, launch is going to have on some of the software stocks' business models and their potential earnings. So I'm going to ask you, Christina, from a quality perspective, because you, from a quality manager, do you have quite a few stocks that have been hard hit by this particular move? I do think, and you're starting to see, it's been indiscriminate selling. It often is that case with the markets. There's one negative move and everything sells across the board. And I don't think it's a fair representation of the quality of the businesses that you've selected. So if you could just highlight how you're thinking of what's going on in this market, and maybe why you think there's great opportunity in the stocks that you have.
So it's a great chart to look at. And if you look at this, you see this, you think some sort of big event has happened. This company has missed on earnings. They cut guidance. But what we've seen is that nothing like that has happened with the stocks. All of the move is been PE compression. So they've been meeting targets. They're doing the same top line growth they've been doing for a long time, the same profit growth, the same earning growth. The disruption is purely to do with the narrative currently in the market, which is AI, and that cloud co-work is going to disrupt these companies. So the exposure we have in the Evenload portfolio is towards companies that sell data. They're data vendors, so they're technically classified as industrials, but they're trading very similar to the software stocks. So what these companies do, they're names like RELX, Wolters Kluwer, Experian, London Stock Exchange. So they sell all sorts of data and analytics to professionals to help them make decisions. So accountants, lawyers, financial institutions. And they have a lot of generations of data and also how this information is being used. And on the way here, Hugh has been reading a lot of books about South Africa and a lot about South African history. So he's a very kind and generous man. He's been sharing a lot of this information with me on the way here. And you know what the population of South Africa is roughly 60 million. Like the size of South Africa is 5 times larger than the UK. And this is all great, but us being here doesn't replace the generational knowledge that the people that live here have, the local intelligence that exists on the ground. And what this company, what the corporates speak is for this term is proprietary ontology. So all of these companies, RELX, Experian, Wolters Kluwer, they don't just sell you the pure commoditized data that you can find on Google. They sell you the really valuable stuff, how this information is being used and implemented in practice in real life. And for you as a business and enterprise, it's very risky to pull out all of this history of use and data to start using instead some sort of application that was vibe coded in an afternoon in someone's garage. You're never going to do that, right? From a compliance, a risk perspective, you have to show your workings to the regulator as well. So we think, to use David's expression, that our portfolio is very sexy as well at the moment because we have these amazing companies that the fundamentals haven't changed, but they're trading at a massive discount in the market.
Awesome. Thank you, Christina. I suppose maybe the next question then I'm going to land to David. Obviously, we've seen this. It's quite a nice segue because the market's sold off.
I thought you were going to say sexy and that.
Oh, well, and that. But the market's sold off. There's a lot of attractively priced, I suppose, stocks on the market. But from a value manager, you navigate the cheapest part of the market, right? The cheapest quintile. How do you ensure when you're buying stocks, you're not buying the ones that are cheap for a reason? You're not going into those value traps. What is the way that you think about avoiding those stocks that are cheap for a reason?
So value traps is just a fancy word for mistakes. And we make plenty of mistakes, but we happen to also have a lot of winners. So the winners make up for the mistakes. We actually measure our hit ratio in terms of how right we are in earnings and the stock, etc. We have about a 60% hit ratio, which is rather high in the market. But the way to avoid mistakes is obviously to control what goes into the portfolio. And then when it's in the portfolio, make sure you don't have too many eggs in one basket. And then make sure that it exits the portfolio when it needs to. So there are 3 parts to that answer. So in terms of what goes into the portfolio, we have a very defined process: value, quality, and analyzability, right? Cheap, good, and simple. And we just stick to that process. And that makes sure that we don't get as many value traps in the portfolio because we look not just for value stocks, but for the good businesses among the value stocks that are analyzable. So we stay away from the bad and unanalyzable businesses, even though they also may be cheap and some of them may work out. Now, in terms of in the portfolio, what we do is we try to avoid too much concentration because we already have a very concentrated portfolio of 50 stocks in our global value fund. So we look to have no more than 5 stocks in any one industry. And in fact, among our 50 stocks in the global value fund, we have about 46 different industries, because they already have the value factor. So we want to make sure that you don't have too much exposure to anything else. And in terms of the stocks exiting portfolio, we have 4 very strict reasons for selling. Number 1 is if a stock reaches fair value, we take it out of the portfolio. We don't hold it if it's already reached fair value. Number 2, if there's a merger and acquisition in the business, we just sell. We don't stay in. And if there is sometimes a superior substitution outside of the portfolio, something that's even cheaper and a better quality, then that will push out something in the portfolio. And then finally, we lose conviction in some stocks, mistakes, or recognize mistakes, and we just take them out. But there are sometimes small things that happen that are not as obvious, something like reaching fair value. That's kind of an obvious thing, something we can measure. Sometimes there are smaller mistakes along the way. So we've instituted a process that we call the yellow card rule. And there may be things that happen with stocks along the way that are not clear enough to sell them as a mistake, but it's something that makes us think. We sort of say, that's sort of weird. They miss earnings more than 10% in a quarter, for example. So we give it a yellow card. And if something else happens like that along the way, they get another yellow card. And on the third yellow card, they're out, no matter what. And now they can retract the yellow cards if they improve, from having lost earnings. But that's sort of the way that we sort of consult them out of the portfolio. And that way we manage to stay away from a lot of mistakes or value traps.
Well, thank you. Thank you, David. I suppose then talking, because a lot of you spoke a lot about the sell, I suppose how you stay away from stocks and your sell discipline also. Naturally, that goes to you, Mark. A big reason why there's a lot of growth managers that are well known in South Africa and well widely used, actually. But when we look globally to find these best of breed managers, besides them being very distinct in terms of the investment processes and philosophies, something that stood out from us from a growth perspective was Jennison's sell discipline, which is so important, especially in a market where there are potentially higher valued stocks, what people perceive potentially higher valued. So perhaps if you can just answer two questions. We've had the two team members here, Lyrical and Evenlode, so it's generationally cheap and free cash flow yields of 5% above the market of 3%. So clearly there's value there. Where's AI, where is growth manager sitting now from a valuation perspective? And then also, if things change in your mind, what is your sell discipline? Or what do you look at when your thesis of any of these companies have changed?
Sure. Yeah, in terms of, we don't quite understand why. I mean, we can make up reasons why, but that's not helpful. Intellectually, we don't understand why our portfolio is so cheap. The big leaders in the market are selling at, in many cases, discounts to the S&P 500, which is crazy because they're putting up monster growth rates. And the consensus estimates also show for continued very, very strong growth. And our estimates are higher than the consensus. And we could be wrong, but the market's not pricing in any kind of optimism. Let's put it that way. So it's a very curious market, and it may be just more risk averse. I think there's an unsettled nature, obviously, to the global economic system, thanks to the United States. And I think there's also an unsettled, long duration understanding of what Gen AI is going to do to different industries that may be weighing on confidence. But whatever it is, it's pretty inexpensive. So we actually don't worry about valuation at all, given the environment today. We're just focused on fundamentals. On the sell discipline, it's really important. Every company has its day, right? So some may last a decade or longer. Some may last 3 years. I mean, if it's a healthcare company, it's going to last 3 years on average. You get in early, they launch a multi-billion-dollar blockbuster drug globally. If it's a very good drug, it'll get utilized very quickly. The PE multiple of that company will expand fairly dramatically, not just on the earnings growth, but on the outlook. And then you're going to start to see competition come into the market with early stage development efforts to go after that big profits pool. And then the multiples always start to do this over time. And so you have to sell, so those are product cycle driven stories, which we have in our portfolio. They're different than those long duration big compounders or long duration stable growth. But even in the case of long duration stable growth, that kind of low double digit growth, a good example is Ferrari. We owned it for 8 years. It was one of the best stocks to own in the European market, and in the global market easily beat MSCI. And it's not dynamic. It is sexy. Um, but it's not dynamic. I mean, you can't visit that company and not want to. You just can't bring a checkbook with you because you'll be broke when you leave. The product is phenomenal. So very steady growth algorithm, mid-single digit volume growth, 3 to 4% pricing growth through mix, special edition vehicles, whatever, and then 3 to 4% pricing from revenue growth from customization. You want the yellow Ferrari horses on the side of the vehicle, $3,000. All right. And so the average customer spends 80 grand on customization. So, and that's all huge profit, right? So that growth algorithm worked for a long time. And so the stock got a very premium multiple as a result of it. It was a six-bagger for us in terms of the earlier conversation. And then in October, it was over. They had a big investor day. They cut the growth rate in half, said volume growth is now going to be 0 for the next 5 years because something's going wrong in their algorithm and they want to cut back supply to make it more scarce. So we don't try to ask too many questions about that. All we know is the management thinks it's not the same Ferrari. And so we sold, 90% of our holding that day. So the sell discipline's key because you want to lock in all of that alpha that you earned over a long period of time. You don't want to give it back thinking that, well, it'll get better someday in the future, or it's a great brand, et cetera. No, it's broken until proven otherwise, and we don't need to be there. So when we see a change in the fundamental strength of the company, their ability to exceed consensus expectations is now waning, and it's usually highly valued by then. You have to sell. Tesla is another good example in October of 2022. That's the first time they ever missed shipment numbers. You have to unload because it's going to turn out to be pretty messy.
Awesome, thank you. And I suppose then just quickly, we've got a lot of questions, and so I'm so glad the team, everyone here is going to be around to answer some questions. So I can't get through them all. I'm going to quickly touch base on portfolio overlap because I think it's a really interesting slide. Well, personally, I said earlier, we chose these managers for their very distinct reason. And what's interesting, although they concentrated portfolios, you heard Sanisha earlier talking about it's time for stock pickers. It's the market for stock pickers. This is what these team members are doing for each of their portfolios that they manage for us. Of their portfolios, and we can always send you, your fund specialist can send you the full list or breakdowns of exact stocks they hold. But what's interesting between the quality and growth manager being Jennison and even though there's only 4 stocks that are overlapping, but something that's more interesting to me is the fact that all 3 of these managers that follow a valuation principle, that look at fundamentals, businesses with strong business moats, durable businesses, sustainable business models, structural growth, but then obviously a company like Jennison that looks for structural growth tailwinds, all of them find a business case or an investment case for Nintendo. So I would love you, all 3 of you, to just touch base on your investment thesis coming from a probably very different reasons and angles.
Sure, happy to start. So for us, any company we look at for it to fit our definition of quality, it needs to have strong financial metrics, and Nintendo more than fits the box there. But also they need to know what their competitive advantage is, and they need to demonstrate to us that they're investing to protect that competitive advantage. And for Nintendo, that is the IP and the hardware design they've been built over generations. A big structural advantage the company has is that now we have something like 4 or 5 generations of people that have grown up with this IP and love this IP. So I know Ray just bought his daughter's a Wii console. So we've had Nintendo for a long time, is going through a console cycle right now. It's been a bit sold off by the market, but we don't think the fundamentals have changed. The games are very fun to play. They understand what their market is, which is family-friendly video games. I say sometimes that Princess Peach and Mario are never going to run a drug cartel in Vice City. They don't compete for that market. And I think it's a good stock to have for the long term.
Lyrical?
Sure. We have value, quality, and analyzability. So let's look at it from those perspectives. Value, is it cheap? So Nintendo is trading as 13 times next 12 months earnings. It's cheap. The market's at 20. MSCI US is at 22. Definitely a cheap company. Is it a quality business? Well, absolutely. 20 out of the 25 biggest games in history have been Nintendo games. Mario and Pokemon have made more money than Harry Potter. Clearly a good quality business. Has an ROIC, return on invested capital, of north of 40%. So well above our hurdle of 10%. And if it's analyzable, absolutely. No, they're just launched Switch 2 and launching these new, launching a new Switch is sort of like launching a new iPhone, and very analyzable business. So it fulfills and checks all our boxes of cheap, good, and simple. And that's why it's in our global value portfolio.
If I build on what Christina said about the competitive advantages and its position place in the marketplace, that we would, obviously completely agree with that. And then the second aspect that attracted us to it is we are looking for product cycle stories, right? These are non-correlated, idiosyncratic ideas in the global marketplace. Doesn't have anything to do with AI or anything else. It's just has a very unique product cycle coming with Switch 2, which was launched last July to great fanfare. And unfortunately for Nintendo, it is, given all three of us on it, it is your worst contributor to return in the last 8 months. So it's on the short leash. So what they have to do at this point for us to continue to own it is they have to launch very successful games that you can only play on the Switch 2 platform. And they haven't really successfully done that yet. But they have a big product launch schedule coming up over the next few months. And if it really is well accepted by the market, it's, green light, and it's really going to move because it is inexpensive. But the market's very concerned that it's going to be disappointing at this point.
Yeah. Watch the space for Nintendo video games releases.
Maybe following up on portfolio positioning from a global perspective in terms of how you put together or construct your portfolios. I mean, this is just there's 5 stops there. But Lyrical and Evenlode primarily focus on developed markets. Jennison, from our growth manager, also takes a stab in emerging markets when there's valuations. I mean, you've got Mercado Libre as an example in terms of a stock. Perhaps you can explain how you're taking advantage of your global mandates from different perspectives. So what's your positioning against the US? Because that's often a question we get, and it's actually a question that's come up. And then I suppose, Mark, you can also just delve a little bit into your emerging market thesis.
Sure. On emerging markets, we don't view it as an asset class or a unique set of companies. It's just sitting there, right? We invest bottoms up. So for us to be involved in emerging markets, it's because we find a really interesting company doing something very unique. And if I look at the last 15 years, I think our peak in EM weight was probably 25%. And that also matched the boom in China internet. And internet around the world in emerging markets. And our trough has been as low as 3%. And today it's at a reasonable level. I mean, it's sub 10% right now. But as a growth manager, we're not looking to replicate beta in emerging markets because we don't think that works anymore. It hasn't worked for a long time. We don't look to replicate growth rates because the United States grows faster than Brazil. So why do we care about the growth rate of the country? We're just there if it has a great idea. So if you look at Brazil, for example, we own Nubank, which is a digital bank. 46, well, no, now it's over half. It's 56% of the adult population of Brazil has an account with them. And there's no branches. It's all on your mobile phone. And it provides a complete range of financial services at very low fee. And they use AI to figure out credit scoring for customers because credit scoring doesn't exist in Brazil. So why Nubank is successful and has been a good stock is they are meeting unmet need in the marketplace. It's as simple as that. They're solving for convenience and low price. And that company's growing like a weed. So that's the kind of emerging market stock we're looking for. Not because we don't play in commodities and traditional financials and things like that, old telecom. We're really looking for excitement. And unfortunately for China, the government ruined the internet, and that was the hotbed of innovation in that country. Great growth companies there that we owned for years, like Tencent, Alibaba, et cetera. But we're not active there today.
Yeah, so for us, we look for companies with strong fundamentals. We find that most of those companies are in developed markets. So what we say is that we wouldn't own the second best company. So Hermes is an example of a company that we have in the portfolio because we think it's the highest quality you can get in the luxury sector. We wouldn't own a Richemont. So we would rather have a concentrated portfolio of companies with strong fundamentals. We have exposure to emerging markets because a lot of the companies we own, they generate over half of their revenue from emerging markets. So a lot of consumer staples generate a large part of their revenue in emerging markets. Experian participates in the Brazilian credit market as well. So that's how we position the portfolio for now.
And yourself?
We're pure bottom-up investors. So the result, the asset allocation in terms of the global fund, we are underweight the US, but it's a result of just finding better opportunities elsewhere. But it's pure bottom-up. So we don't make any reallocations to countries or regions based on what we believe that region may do. And again, just to emphasize what Christina mentioned, is that many companies obviously have their earnings come from various reasons, even though they may be listed in a certain country. We own a company called Elis, a French laundry company. They take laundry from hospitals, uniforms, etc., and they wash it in central place instead of having the hospitals wash their own laundry, for example. It's a French listed company, but you can find Elis in the UK as well. You'll see their trucks driving around picking up laundry as well. So its earnings, even though it's a French listed company, may come from various places, wherever they've decided to do business.
So thank you, David. Very different positioning, but I think what's important to hopefully you got from today is that all three of these managers are focused on their philosophy. They don't deviate. And I think that's an importance. Each portfolio and I suppose investment style is going to go through periods of outperformance and underperformance. And that's a big reason why we actually advocate blending the investment styles, because you can never time when to enter and when to exit. So, and definitely, if anything, all of these portfolios have value to be had. They've all said they've had value. I've never heard of that before in my life, but so they've got value, different positioning. They think differently. Whilst they've got emerging market exposure directly or indirectly, it's globally diversified. And from a access point to these particular strategies, we've got US dollar denominated portfolios, but we're in the process of launching rand denominated feeder funds because of the demand for these portfolios. Thank you so much.
At the beginning of the day, I said to you that we wanted to showcase different thoughts, different managers, and create hopefully an event that you find value in, because you're seeing the diverse views and at times opposing views in one place, so that you can take that back to your clients. I hope we have succeeded in doing so. And just a recap on what we heard, you heard Sanisha Pakrasamy, the chief economist, basically talk about it's not yet time for de-dollarization. The US dollar may be unpopular, but it remains resilient. She spoke about gold potentially continuing to be in demand as central banks increase their weighting. And as Natalie said, she also said this is probably a great time for stock pickers. You also then heard from the two Robeco individuals, Karen van Baardwijk, who is the CEO of Robeco, and Jan de Koning. Karen spoke about the resilience that a company needs, how you run one of the largest and oldest asset managers in the world, and how you stick to your knitting. And then Jan spoke about enhanced indexation and the beauty of enhanced indexation in markets such as these. And then lastly, you heard from the three active style managers. All of them believe that their positioning currently, given where the market is perfect for clients to enter. As Natalie said, it's very few times that we've seen this. All of them believe that their portfolios are sexy, and actually there's a great opportunity for them to do well regardless of what comes next in the market. From us at Curate, I suppose what we wanted to show you and showcase is you can be one investment manager and you can be a young investment manager. But what you bring to market and how you bring it to market is important. And we hope that you start thinking about us as a partner in your clients' portfolios that can bring you the different styles and the different needs that you need for your varying clients, because we have almost everything that you need in those portfolios. One or two things you heard of as well. You heard about real assets from Gary and Andrew from the Momentum Global Investment Management team. Your feedback will help us determine what else we put on our roadmap. So thank you. We appreciate your time being here. We appreciate the fact that you've trusted us with your clients' hard-earned money, and we appreciate the partnership that we're building with you currently. On behalf of all of myself and the Curate team behind the scenes, I want to say thank you. Thank you for spending the day with us.